I think that, first of all, we have never experienced in recent time a spread of 400 basis points between what you get on the money market and what you get on your deposit. And second, the world has changed. Deposits are mobile. They are really, Google say, a click away. And so I think that if deposits move in search of better yields, then banks have to realize their losses. The idea of losses held to maturity that can stay there and not have any impact, I think is sort of a fantasy.
Well, what do you think the Fed should be doing? I mean, at a certain point, this is really the consequence of banks not managing their assets well enough, isn't it? Or do you really think this really lies with the Fed?
No, I think that the Fed has a huge responsibility of the fact that they should have understood that they couldn't raise rates so fast. Because when you raise rates so fast, you're going to impose losses in the bond market, and who's going to bear those losses? Insurance companies, then you have to bail them out. Banks, then you have to bail them out. So unless all the losses are among us, investors, individual investors, then something happens. And so that was an extra reason to intervene early on the inflation. They were very complacent and said, oh, we have the tools, we're going to do it, we let it go a little bit, but don't worry because we have the tools. I think that their tools were not very sharp, and they should have recognized that.
How much do you think that the banking crisis that people talked about 3 weeks ago has abated, has really sort of moved from some sort of acute phase into perhaps a chronic question around flows and with respect to credit creation, but not necessarily a crisis?
I think it's possible and hopeful that there's not going to be an open crisis like we've seen in the past. However, clearly put a lot of softness in the banking sector, particularly regional banks, which we need to remember, those are the ones who lend to small and medium enterprises. The large banks tend to do syndicated loans to big firms, but the bread and butter of the economy is with the regional banks, and they are very soft, and they see deposits flowing out. And they are not going to make loans because if they make loans and then deposits flow out, they have to sell securities and they have to make losses. So I think that the first thing they do for sure is not make new loans. And then probably they're going to try to slowly divest their securities when they can. We saw there was an article on the FT showing that at the beginning of the year, cash over assets in banks were particularly low. And they say this is the cause of the current crisis. And no, this is an effect of the fact that we have a withdrawal of deposits. And so banks don't want to divest the securities at the loss. So what they do is they reduce the cash they have.
The deposits, let's touch on that. You've been highly critical of the Federal Reserve. I'll be the last in line to defend the Federal Reserve, so let me be clear about that. But we do need to talk about the role of the banks in all of this. You got any criticism for the way the banks have been run?
Look, I think that if you don't expect some bankers to be stupid, you have not learned the lesson. And so Greenspan said that he was surprised, was surprised how little people were trying to do the right thing, even if they had the right incentives. So we learn that people make mistakes. A resilient system is a system that can bear the mistakes of individual bankers, especially when these bankers are not the CEO of JP Morgan.
If I go and open an account this morning, if we went out, Lisa and I, and open a joint account, a surveillance account, without Tom's name on it, because we know what would happen to the cash, but that's another story. They'd probably offer us 0% for one of the big names. Still, we've got Barclays out in the last 24 hours saying that money market funds could go up another 1.5 trillion. Do you think the concern right now at the banks is return of capital or return on capital? And can they prevent deposit flight by quite simply just putting up interest rates on deposits?
No, they can't. They don't have the return to do that. If you look at Silicon Valley Bank, if they had increased the return on their deposits by, I think, 75 basis points, they would have wiped out all the profits last year. So I don't think that they have a return on assets that justify a higher deposit. That's the conundrum. If the problem were solved simply by increasing rates, it would be easy, but they cannot afford to.
So you're saying this banking system does not work with rates of 4% plus? Is that basically what you're saying?
Yes.
So does the Fed have to cut interest rates, and do we just have to tolerate inflation?
First of all, I think the inflation might not be as big of a problem if we get into a recession. I think the recession will do the job. Now, that was not the plan of the Fed. It was a soft landing, not crashing the banking sector. But that's a part that they should have seen.
So let's just put this into perspective in terms of bad news being bad news, which seems to be the new theme in markets right now. How much is what you're talking about underpinning that there is an imminent tension that's going to perhaps accelerate some sort of economic downturn because the banking system just is not going to function at these rates?
I think that is the underlying bad news. Now, this is tempered by the fact that this will come with a reduction in interest rates, and as we know, that compensates some of the problems. So I think that the real tension is the Fed will not raise interest rate more, will probably at some point cut them, and is there going to be enough to transform what is likely to be a hard landing into a more soft landing? That's the question. I think that we are softening up and there will be a landing at this point. In my way, there is little doubt. The question is, how hard?
Let's finish where we started. The changes you want to see. The changes you want to see over time, but I want to talk about the changes you want to see in the next couple of months. What would you like to see announced?
From the point of view of the Fed, from the point of view of the government?
From the Federal Reserve.
I think that a serious analysis of what are the softness in the banking sector. I think there was a regulatory failure, and the Fed needs to own it and change. And two, I think that be honest about the fact that probably we need to soften up interest rates because the banking crisis is coming, and try to find way to soften up this banking crisis, especially, I think, for lending on small and medium businesses, because those are the ones affected the most.
You said be honest. It implies that they know, but they're not saying it. Do you truly believe that?
I don't know what, you can be honest and being wrong, and I think sometimes people believe their own view of the world. I think that I honestly did not understand the 25 basis points increase last meeting. I thought that was just a signal to say, I want to reassure that things are not as bad as they might have been. Was not determined by the objective situation on the ground, but I've been wrong before, I can be wrong now.
I just wonder whether there's a role for regional banks anymore, which are such a mainstay of lending. I mean, basically under your paradigm, not really.
No, there is a very important role of regional banks, because we know that small businesses don't borrow at a large distance. They depend on local banks, and particularly also minorities depend dramatically on, for example, minority banks. I had students who went on the market this year showing how important is bank ownership in determining who gets the loans. So I think we cannot say we only go with a few large banks, because that means a complete change in the U.S. economy.
This was so good you can promo your podcast. What's it called?
Capital isn't what is working in capitalism and what isn't.
Nice. Where do I find that?
Anywhere you get your podcast from.
There we go. That's perfect.
You were that good that he basically was like, go for it. You have won yourself an advertising spot.
10-second promo. I'll get in trouble with corporate now for giving that away. Luigi, thank you. This was fantastic. Thank you. Luigi Zingalos there of the University of Chicago School of Business, with some big questions there, Lisa, for this Federal Reserve.
And really important ones at a time when bad news is bad news, not necessarily because of some sort of a potential other event other than what's going on with the banking system.
We're effectively saying that the banking system in America does not work with rates north of 4%. That was that last conversation.
And that's the reason why people are so curious about some of these flows, and frankly, about how quickly deposits continue to leave some of the smaller banks.
At a time when the Federal Reserve is saying we're going to 5+ and we're going to stay there for the rest of the year.
Which is the reason why we're pricing in rate cuts.
It's an amazing conversation. Futures right now on the S&P, unchanged from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's no secret that China wasn't happy about House Speaker Kevin McCarthy meeting with Taiwan's President Tsai Ing-wen in Southern California. The country had released statements condemning the meeting, but political experts tell Bloomberg President Xi Jinping has several reasons to hold off on any aggression. Now, he's currently hosting French leader Emmanuel Macron and European Commissioner Ursula von der Leyen to win support for his plan to bring peace to Ukraine. There was violence in Jerusalem for a second straight night. Palestinian worshippers barricaded themselves inside the Al-Aqsa Mosque, and Israeli police used force to remove dozens of people. Police said young people threw rocks and other objects at officers. At the same time, Palestinian militants in the Gaza Strip continued their rocket attacks on Israel. Donald Trump's presidential campaign is trying to enlist donors who have supported Florida Governor Ron DeSantis. The campaign is using polling numbers to show that the former president is an unstoppable force in the race for the Republican nomination. A memo describes him as pulling away from DeSantis in voter surveys and says his indictment in New York is rallying Republicans to his side. Elon Musk says converting the world to entirely clean would require $10 trillion worth of investment. But he says that continuing to rely on fossil fuels would cost $4 trillion more over the next 2 decades. Musk's thoughts are in Tesla's new Master Plan Part 3 document. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
See a very strong demand for traffic of passengers around the world. There was a very strong demand for cargo during COVID. So the return to good times is indeed accelerating. We see now the opening of China contributing to the global recovery of the sector. And it's now a market where demand is actually stronger than supply.
That was the Airbus CEO speaking to Bloomberg back in February. Airbus making some moves over in China, Lisa, and this was the story you were talking about a little bit earlier this hour, the difference between the approach from Europe and the approach from the US. In the US, the C-suite in America overwhelmingly is having this conversation about de-emphasizing investment in China. At least that's the conversation we have on a weekly basis. Airbus is, I would say, doubling down in some sense this morning.
100%. They're building a new China jet factory, and they're increasing their ties with the second largest economy in the world. It makes sense economically, but how does this tie into this feeling, especially given the fact that Germany's Olaf Scholz has come out and basically said, we need to be aware that this could potentially be a point of tension. At the same time, all these European officials are heading over to say, let's strengthen those ties.
Let's head over to Guy Johnson, a man who knows this company far better than I do. Guy Johnson joins us out of London. Guy, what does Airbus get back for this one?
At the moment, not very much. So a number of things to say here. John, we're waiting for details. I've been in touch with Airbus. We don't have all the details we want. There has been an embargo broken, which is why we've got the story on the final assembly line, the second final assembly line, but we don't have all the details we want because we haven't had the official sign-off from the Chinese. In some ways, the Chinese are getting exactly what they want here, John. They're getting a second final assembly line in China. But the key thing that the Airbus was expecting going into this trip, we understand, was a big order for A350s, the medium-sized wide-body that Airbus builds, competes with the Dreamliner. That hasn't happened at this point. We don't know if there's going to be a big order here. In fact, we think there probably isn't going to be a big order here. So China's getting a new final assembly line, and it doesn't have to commit to new aircraft in terms of big order for A350s. Remember, this is a country where Boeing is struggling. And you would have thought that would leave the sort of the piece open for Airbus. Boeing, remember, has got the MAX recertified, but there's no new deliveries. Boeing hope that's going to take place later this year. But this should be wide open for Airbus. They're making the commitment, but it doesn't seem as if they're getting anything back. And that's really interesting, I think. I wonder if there's political messaging in that as well.
Let's talk about the politics and the political messaging at the moment, Guy. It's happening at a time where Macron is over there in China, alongside Ursula von der Leyen. Are we saying that the US and the Europeans are competing with each other in China at a time when the US is trying to keep the Europeans on the same side?
It's fascinating, isn't it? In some ways, Airbus is not competing because Boeing, in many ways, is not present in China. And the Apple story that we've obviously run, Mark Gurman's fantastic story about Apple's kind of new strategy when it comes to China, I think is kind of part and parcel of this whole narrative as well. The Americans are being much more cautious. The Europeans are maybe filling the space that the Americans are leaving behind. Is that going to be the narrative going forward? But the lesson must be learned from Russia, John, with stranded assets. A lot of European companies, particularly German companies, ended up with stranded assets in Russia. Is there a danger that a similar story gets repeated with China?
That concern doesn't really seem to be in the forefront. And I have to say, it was interesting to me that Emmanuel Macron sensibly was going to China with Ursula von der Leyen to talk about potentially brokering some sort of peace agreement with Russia for Ukraine. How much is this really an economic-based visit where you're basically seeing Europe try to strengthen its economic ties and trade ties with China?
The two, Lisa, I think are always hard to tease apart. The Europeans have operated a more mercantile approach. Certainly the Germans have, to the French to a certain extent as well. So it's always hard to sort of differentiate the two. But nevertheless, there is a big kind of politics story here that is underway. I think Europe's relationship with China will ultimately be defined by the way that China uses its influence over Russia to define what happens in Ukraine. And I think that is probably the bottom line here. But in the meantime, while the US looks to disengage, the Europeans are not doing that. They're engaging still, and they see that as being the best sort of path forward, both economically and politically at this point.
This is really an important point, Guy, and I wonder how much this just goes back to the daylight between the U.S. and European approaches, that Europe sees the trade ties as being leverage, and the U.S. views the trade ties with China as being a potential liability. Is that something that you hear increasingly as some of the U.S. and European counterparts try to get on the same page and fail with this particular issue?
Well, I think it's really difficult. There is definitely a different ethos at work here with both sides. It'll be interesting to see how that plays out in, for instance, negotiations over the Inflation Reduction Act. But if you look at what has just happened, let's assume that the details are confirmed as we anticipate that they will be. The Chinese have basically just delivered a commitment from Airbus that it's going to build a second final assembly line. They haven't had really to give anything back. We don't know the financing details around all of this. So at the moment, the Chinese seem to be getting the better end of the stick here with the Europeans. The Europeans maybe see an opportunity economically, but where does that ultimately take them with their relationship with the United States? The Europeans think they can play both sides. The Europeans clearly think that they can keep both sides happy. We'll see whether that ultimately turns out to be true.
The larger backdrop, Guy, has been better than expected economic performance and frankly, wage growth in Europe at a time when the U.S. seems to be seeing potentially a bit more weakness. We talk about sort of the diverging credit tightening cycles, but how much of this really is tied to China's reopening? And even if it has been underwhelming to some, that it has given a real boost to Europe's economy?
the further you go east, seems to be the narrative at the moment, Lisa, the better the economic news. So Europe, in some ways, I appreciate you can go the other way, but Europe is closer to the Chinese story. And the Chinese story does seem to be gaining momentum. It was interesting to listen to what Walmart had to say yesterday about returning sort of consumer confidence in China and how that is starting to pick up the pace. So Europe is set to benefit from that. How much of that is already priced in? We'll wait and see. Look at what is happening with the luxury goods sector, which has broken out recently. It's done very, very well. That's based on that China trade. How much more juice is there left in that particular tank? I don't know, but it's come a long way very, very quickly. So I think there is certainly a European, the Europeans are getting more of a positive picture from China. Have the markets already anticipated that and priced that in? I think if you look at names like LVMH, maybe that is the case.
The stock's up 22% year to date. Absolutely flying, the luxury players. Guy, can I change topic just quickly? Have you seen this latest research piece that the US is becoming more like Europe? The average US work week has dropped by more than 30 minutes over the last 3 years. Guy, have you seen that data?
I read that story. I thought it was fantastic. 30 minutes when you aggregate it up, it is a huge number. So yeah, maybe ultimately the European way of life is the correct way of proceeding. I thought also you ally that, John, with the AI story, the ChatGPT story, that maybe we all get Friday off. That's Chris Pisarino.
I wish Tom was here for this. I really wish Tom was here for this. Guy, thank you. Guy Johnson.
Hasn't he got the day off? I know it's Thursday.
He's taking a couple extra half hours to make up for the whole
more
thing.
European. Yeah. Let's be clear about that. Tom Keane is becoming more European. Guy, thank you. Lisa, you have thoughts. I know you have thoughts.
I have so many thoughts.
Share your thoughts, please.
Okay, first of all, people say from an economic perspective that perhaps this is the labor market tightness, that people are just doing less. How does this also connect to quiet quitting and people who are just basically aren't working all that much anymore and prioritizing their home lives after the pandemic? And then what does that mean? Whether there's perhaps a divergence going on, where there's some people who work a lot more than before the pandemic and some people who work a lot less, and that averages out to perhaps a little bit less. I'm just saying, like, these are some of the thoughts that I had in
You want a
discussions.
compositional story. Rich Miller, our thanks to Rich Miller of Bloomberg for writing out this story. So there are 3 groups you need to think about, apparently. Educated young men, they've been reducing their hours. High earners, they've been reducing their work week by 1.5 hours, I'm told. And workaholics, who reduced their work time on the job to only 52 hours a week from 55 back in 2019.
Well, okay.
There's some of the composition behind this.
Thank you. I appreciate that.
That's what I'm here for.
I do think that there has been a reset after the pandemic about home work balance, just because people were forced to actually be home and experience what it was when they didn't have the excuse of work. I'm just saying, theoretically, it required some shifts and in order to make certain things work. But I also think that perhaps there are more kind of trends going on.
What's wrong with becoming more European?
Nothing.
You know,
Can we?
What's wrong with that?
We just spoke with Max Kettner, who's skiing in the Alps. I mean, honestly, let's become more European. And did you see, like, the way that they have a whole lifestyle and you can stop at little chalets?
Hey, you know, what's wrong with that?
Absolutely nothing.
It's great.
Preaching to the choir.
Take 2 weeks off in the summer. Take a month if you want to.
You know, I don't think we're moving into that direction because what you end up happening.
Too soon?
It's, I mean, please, just ease us into it, okay?
We'll do an hour a year. Just cut it back.
I think we're trying to. I think we did, according to this study.
Terry Wiseman of Macquarie is going to be joining us shortly. Looking forward to that conversation. Equity futures right now unchanged on the S&P 500. We've had a string of weaker than expected data through the week so far in America. More data coming up, 8:30 Eastern Time. Jobless claims just around the corner.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, But that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There's places to put money to work in the market, and you can work your way through this chop and churn.
We had stocks that have rallied at the same time that we've had continued economic data that tells us to be cautious.
I think we're in a generational opportunity for investors to get really high quality income in the fixed income markets.
There's that level of flight to quality, but I think some of the broader panic in the market has kind of come back a bit.
There's a few things happening in the US that are quite different to the rest of the world.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is Bloomberg Surveillance, gearing up for a long weekend for some of you. For others who might have to tune in tomorrow morning to go through the payrolls report, the weekend hasn't started yet. From New York City this morning, good morning for our audience worldwide. Alongside Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance live on TV and radio. TK is going to be back with us tomorrow morning. Looking forward to the conversation around payrolls. Equity futures right now unchanged on the S&P 500, but you know the story so far this week. The data weaker than expected. Lisa, the question, will it continue?
And what has really accounted for the shift? And it's been a market shift in markets where basically, as you said, bad news is bad news. And we've seen this for now 3 straight sessions, which makes a trend. And that will be a new narrative that we can just basically pin, given the fact that we get a new narrative every week. And the narrative now is that we are going to get some sort of slowdown. And we're just getting the appetizer with some of these disappointing data points.
Now, Mohamed Al-Arian said to Francine Lacqua in the last week that you can't respond to every data point. Might be true as a policymaker. You can't edit the speech every time you get something new, the ISM manufacturing services, whatever. You've got to wait around for something to change. Do you think increasingly, as this data comes out this week, that some of the communication from the Fed is starting to sound a little stale?
I think the market's completely disregarding it. And the longer this sort of divide goes on, where you've got 100 basis points of rate cuts priced into the market, and you've got a Federal Reserve still talking about north of 5% Fed funds rates and holding them there for a longer period of time, there's a question about Fed credibility that really goes to the heart of some of the discomfort and volatility in markets right now. And I think yes, stale perhaps, but also out of touch with what other people seem to be seeing.
The Fed is communicating 5, north of 5, and hold, 3-year end. Luigi Zingales, the professor from the Chicago Booth School, sat around this table with us 20, 30 minutes ago. And if you missed that conversation, please check it out on Bloomberg.com when we upload it a little bit later, saying that this banking system does not work with rates of 4-5%.
that to me is the story that's underpinning the shift in narrative. And I think is the story that you have to watch, because you are seeing the ongoing underperformance of the KBW index of banks. You see this sort of regional banking concerns, the jitters that come up when you don't have a sense of what the deposits are doing. There is a feeling that people will continue moving their money out of these smaller banks, regardless of what happens, regardless of whether they're stable, simply because they're getting more elsewhere. And this fundamentally questions one of the main credit impulses in our economy. That, to me, is driving the underlying feeling that bad news is bad news.
Where are we going to be on May 3rd when the Fed next makes its decision? Before we get to May 3rd, we need to talk about data, payrolls on Friday. Next Wednesday, you've got the CPI report, and then a load of bank earnings in between as well. Let's give you a flavour of the price action this Thursday morning, and good morning to you. Equity futures just about turning positive on the S&P. Let's call it unchanged. Yield still lower across the curve on a 10-year, down 2 or 3 basis points to 3.28 on a 2-year Lisa, down another 5. 373 on a 2-year this morning.
And we've seen some of these levels reach the lowest that we've seen going back to September of 2022. Again, as the Fed says, they're going to raise rates to 5% and hold it there for potentially a year. We will track that. We also, in terms of the appetizer, the data doesn't matter until it does, particularly challenger job cuts, which come out in about a half an hour time. We never talk about these. Suddenly, I think we will be, just simply because if they are weaker than expected, that will confirm a narrative that people are clinging on to. We also get U.S. initial jobless claims at 8:30 a.m. Eastern. The U.S. Economic Surprise Index has turned negative, and we have seen it grind lower. I am watching this. I want to understand whether this is driving some of the underlying pessimism that seems to be bleeding out even in risk assets. 2 p.m., the U.S. bond market closes early for Good Friday. We will still be logged on, and we will be here tomorrow morning from 7 a.m. to 10 a.m. Eastern about the jobs report that we get out. We're going to be speaking with Priya Misra of TD Securities, Ellen Zentner of Morgan Stanley, as well as former Fed Governor Randy Kroszner and Mohammed El-Arian of Bloomberg Opinion. I believe he's going to be in studio.
Around a table for the hour from 8 o'clock. Very cool.
Which will be just awesome to get his insights, especially as we get that data. And at 4:30 p.m., I'm sure a lot of people are just like me and will be logged on and carefully watching all of these data points from the Federal Reserve, not only on the discount window lending, but also its balance sheet, which ticked up over the past couple of weeks in response to the crisis.
Same. Looking forward to it.
Yeah.
Later on this afternoon.
You're going to be logged on too, right? I mean, it's basically, I set an alarm.
I'm always logged on.
4:30 Thursday.
For
Yes.
anyone on the Bloomberg, the light is always green.
For
Reach
you?
out anytime. Terry Wiseman,
You
global
will
interest
regret
rates
that.
and currency strategist at Macquarie. I'm regretting it already. Terry, thanks for being with us, sir. Good to see you. This from Torsten Slot, literally just moments ago in my inbox. He said the credit crunch has started. He said a survey of 71 banks in the Dallas Fed District done after SVB went under shows a dramatic reversal in loan volumes. The Fed survey was carried out from March 21 to 29. Do you agree with that statement? The credit crunch has started?
Yes, absolutely. You might not want to call it a credit crunch. You might want to call it a credit crumble, but the direction, I think, is unambiguous. And I would add here that it's not just about deposits leaving the system, right? Deposits can, come out of the small banks, and they can find their way into the large banks. They can find their way into money market funds. In fact, the system has a way of recycling those deposits and potentially bringing them back to the small banks, especially if the government leans on the large banks to recycle those deposits, as we saw with the First Republic situation. I'm not so much concerned about the flight of deposits as the origin or ideology of a credit crunch or credit crumble. I'm much more concerned with the regulatory overhang. I'm concerned with the fact that Congress is going to be doing compensation clawbacks, or at least considering that for bank CEOs that get themselves or their balance sheets into trouble. I'm worried about the more variegated stress tests, stressing the banks for duration mismatches. I'm worried about the banks going back into their balance sheets, looking at and scrutinizing them. I'm worried about the regulators doing the same for the banks. I think that is going to cause an overhang of concern, of worry, of less risk-taking in the banking community. That's what's going to drive the credit crunch or credit crumble, not the flight of deposits necessarily. If there is a flight of deposits, all right, then we're talking about not just a credit crumble, but a real credit crunch.
Okay, 2 questions. 1, policy consequences, what the Fed does ultimately in the coming months, and 2, market outcomes. How are you thinking about those 2 things now?
So the good thing with regard to market outcomes is we've gotten 10-year yields coming down, right? And I think to some extent that's supporting multiples. But I'm afraid about the market because if you have a credit slowdown and you have an economic slowdown that follows from it, you're going to have an earnings slowdown. You're going to have a revenue slowdown, effectively an operating slowdown in the corporate world. We're already seeing that with what happened with the manufacturing ISM survey and the headline index. When it falls to the levels it fell in the March report, it's typically historically associated with a big decline in growth in corporate revenues, with a big decline in growth in corporate earnings. It's also associated with negative revisions from bottom-up analysts who cover companies in the S&P 500 and the broader indexes. So that's what's in front of us right now. Now, there could be multiple elevation or because of the low yields, but you can't expect the market to do well in the context of downward revisions in earnings. And I think we're just on the verge of seeing that start.
Just to sort of underscore your point, do you agree with Professor Zingales that this banking system cannot handle rates where they are?
No, and I'm going to qualify it. I would have said something different. I would have said the banking system cannot handle a very speedy, aggressive, and abrupt increase in interest rates to 4%. If any economic agent, not just banks, any borrowers, any creditors get accustomed to very low interest rates and expect those to continue, their behavior is going to accommodate to those low interest rates. And when interest rates rise by a lot, that behavior is going to suddenly be forced to shift, maybe because of what happens in their balance sheets. Duration mismatch at the banks is a good example. So it's not the level of interest rate that matters. We've had 4% interest rates in the past. We've glided through that pretty comfortably, not necessarily associated with a lot of inflation or low inflation. What has troubled me, and I think what is troubling the economy right now, and certainly the credit economy, is the rapidity with which interest rates have risen. That is what is unprecedented, not the fact that interest rates are 4%.
Translate this into the global market. A lot of people are looking at signs that perhaps things are cracking a bit more in the U.S. than in Europe and that things are slowing down as a sign that Europe is strong and go into European assets. Do you disagree? Do you think that they're just 6 months behind the U.S. and that they're going to see the sort of tensions emerge in the economy at the same kind of pace based on some of their outsized rate hikes?
There's something to be said for the synchronicity of business cycles around the world. If the U.S. slows down, it's almost impossible that Europe will completely escape the impact of a U.S. slowdown. But Europe's got good things happening as well. First of all, keep in mind that it was in its doldrums and it was in its slump in the fourth and third quarters of last year. So it's coming off a low base. And when you come off a low base, you can't imagine it's going to be hit hard unless there's another shock. And I have to imagine it's going to have to be more than a credit crumble in the U.S. China's recovering. That's going to help Europe. Right? There's the prospect that the initial shock of the war through the energy price mechanism has faded. Certainly natural gas prices globally are low. Oil prices are relatively low. The things that hurt Europe in the third quarter and the fourth quarter of last year are no longer there. At the same time, the things that are about to start hurting the U.S., specifically this credit crunch or credit crumble, are on the verge of starting.
Is that dollar positive or negative?
It's dollar negative. There's something to be said for the idea that a global recession helps the dollar. I think that's an old way of thinking. I think asset allocators have gotten more sophisticated over time. They can make distinctions between growth rates and the first order, second order growth rates around the world, and the comparisons between them, relative growth rates, I mean. And when we're going to start to see this divergence indicated by the fact that the surprise index in the U.S. is heading down and the surprise index in Europe is still going up, I imagine. We're going to start to see a weaker dollar. We've already seen it, right? In March, we've already seen a weaker dollar. But I think there's room here for the euro to get even higher and break above the 110 level. We've already seen with sterling; it got above its 2023 highs already, right? And the next
threatening parity at the end of September.
And the next shoe to drop may be dollar yen, right? We'll hear more presumably from the BOJ once the new governor takes over. But these are the consequences of effectively of the weaker U.S. situation compared to the rest of the world.
Sterling right now very close to 125. Terry, this was great. Thank you, Terry Wiseman there of Macquarie. Speed kills, not levels. Terry's take.
He's not alone in that. And then this is the question. It kills. What does that mean in terms of economic slowdown? Is this basically what people are saying, that we're expecting the kill to come and to show up later on in the year? When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension, because we're not seeing it yet. I mean, yes, softer than expected, but still, there is underlying strength.
That's a big reason to criticize the Fed, that they moved that fast. They had to move that quickly because they made a mistake. They used the language front-loading. I've always found that frustrating. I know others have as well. They weren't front-loading anything. They were back-loading because they were late.
And, you know, just that criticism has been echoed by a lot of people, including former Fed members like Vincent Reinhart. And we've heard that consistently. This was an error of not moving quickly enough.
Futures right now on the S&P 500 unchanged. In the next hour, we'll catch up with Brent Schutte, the CIO at Northwestern Mutual Wealth Management. We'll do that in about 50 minutes from now. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Beijing, France's President Emmanuel Macron urged Xi Jinping to use his influence to help restore peace to Ukraine. He said that China's president could bring Russia, quote, back to reason and end the fighting. Xi has sought to rally international support for a vague peace plan. The U.S. has dismissed the idea, but France has welcomed China's effort. House Speaker Kevin McCarthy says that China can't dictate who he meets with. McCarthy spoke with Bloomberg after a meeting with Taiwan's President Tsai Ing-wen in Southern California. The gathering included both Republicans and Democratic lawmakers. McCarthy says he would like the U.S. to speed up arms sales to Taiwan. Meanwhile, McCarthy has a warning for Wall Street. You should worry about the political impasse over raising the debt ceiling. McCarthy told Bloomberg he's very concerned about reaching a deal with Democrats, but he's still opposed to increasing the nation's debt limit without curbing government spending. Shares of Costco are lower. A second straight slowdown in a key sales gauge led to doubts about the strength of American consumers. Costco's U.S. comparable sales rose just 0.9% in March after excluding the impact of changes in gasoline prices. It was the lowest sales growth in almost 3 years. And Airbus will double its production of its best-selling single-aisle jet in China. It's a bold bet on future demand for air travel and aircraft orders in one of the world's biggest aviation markets. The move in China is a key part of Airbus's plan to increase production of the A320. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Week. Surveillance is live from Washington, D.C. as part of Bloomberg's extended daily coverage of the World Bank Group and International Monetary Fund's spring meetings.
These meetings, even with the banking crisis in place, are really, really important.
Economic outlook, poverty eradication, aid effectiveness, and more.
How slow could global growth get?
You could have a global recession. Live coverage throughout the day starts April 11th on Bloomberg, your global business authority.
We've never spoken with one voice when it comes to China. We've gone from administration to administration. So when I became Speaker, we created this select committee and had 146 Democrats vote for it. You've watched Democrats and Republicans here together. I think that would even foster a stronger relationship with China because China would understand where our boundaries are. They won't worry about, oh, one party saying something.
Seems to be the one issue that does not divide Washington, D.C. The House Speaker, Kevin McCarthy, speaking with Bloomberg's Anne-Marie. We'll catch up with AMH in the next hour. Looking forward to that conversation. If you are just tuning in, welcome to the programme. Payrolls tomorrow morning. Before we get there, jobless claims in about an hour and 10 minutes from now. Going into that equity futures, just a bit softer earlier on, then unchanged, and unchanged really for the last couple of hours or so. Equity futures not really going anywhere, positive by not even 1/10% on the S&P. In the bond market, yields are lower by 3 basis points, 327.91 on a 10-year. Let's just call that 328 on a 10-year. On a 2-year, down 5 basis points to, let's call it 373. Had a little look at the 360s in yesterday's session at the front end of the curve, Elisa, off the back of weaker data in America.
And this is really the tension that we keep talking about, the fact that this market is expecting rate cuts in the near future, and the Fed keeps saying that they're not going to do that. How does this get resolved? The market's been wrong before. People say, don't fight the Fed. At the same time, the Fed's been wrong too, more often than not in the past couple of years.
So jobless claims 8:30 Eastern Time, 10:18 Eastern Time. Don't miss this. Tiger Woods tees off at Augusta National for the Masters. I'll give you some more times if you like, because I wanted to know earlier on as well. Scotty Scheffler, of course, one of the favourites for this, 1:36 Eastern Time and 1:48 for Rory McIlroy. Do you want to speak 2 p.m. if
Thank
you're
you.
interested?
I appreciate
you interested?
that. No.
You know, no, not at all.
Well, I mean,
it's so relaxing. It's like therapy. Honestly, Augusta National, the way that tournament is covered, is the most relaxing sporting experience on the planet. Nothing comes close.
I'm not a normal person, so have you not noticed that at this point? I wasn't trained
I would never
to
say you weren't a normal
understand.
person.
No, but I am. I'm just saying that I do understand intellectually why it's relaxing. It's just, I wish I could relax to that.
Okay.
Let's move on.
They're your pairings for Thursday and your tea times, and you can find them out yourself if you're interested. And if you are a normal person, you find the Masters relaxing. Maria Tadeo joins us now from Brussels. Maria, the people you traditionally cover day to day are not in Brussels, they're not in Europe, they're in China. Maria, what are they doing there?
Well, there's a lot going on in China. And Jonathan, let's break it down because you have a double visit. In fact, you have the French president today who had a meeting now with the Chinese leader this morning. And again, repeated, double down on this idea that China can actually help global peace and has a role to play. You hear Emmanuel Macron speak in the first person. I am convinced, I believe that you can do this. Obviously, we should make it clear when the French president speaks, he speaks on behalf of the French Republic and no one else. And then separately to that, you have the head of the commission, Ursula von der Leyen, who is also on the trip, and she wants to focus in many ways on the trade situation because, Jonathan, let's be very honest here, everyone wants to benefit from the China reopening. That is crystal clear for everyone. What the EU says now is that they want to rebalance the relationship, but also it's too late to decouple, so we have to de-risk, now. So that means look at areas in which China is profitable, but also other areas where it can be risky to do trade with them.
Maria, how much is this the most attractive option for European officials who are kind of stuck between a rock and a hard place with potentially waning support for the ongoing war in Ukraine in terms of continuing to give support and continuing to sort of remove all ties with Russia while also trying to back Ukraine and get some sort of expedient end to this?
The idea of how Ukraine ends, obviously, and the mediation that China could play, that is controversial, and there is no consensus. That we should make it clear. When Emmanuel Macron this morning comes again and repeats that China can help, he also says, by the way, at this point, everyone should be clear that the only person that has some clout over Vladimir Putin, because everyone else has gone cold on Russia, is the Chinese leader. Maybe he can help with that. But that is not consensus across the EU. I've spoken to a number of officials officials who say if China really wanted to mediate, they've had a year to do it. They've not even called Zelensky once. I've also had officials, and I spoke yesterday with Lithuania's foreign minister, who said, when I look at what China is doing, that to me is not a peace plan. China only cares about China, and they do not have a view on global peace. They just want to advance their agenda. So this is controversial when it comes to what can China do to de-escalate things in Ukraine.
So what was the purpose of this meeting with Emmanuel Macron, the meeting that's ongoing, and Ursula von der Leyen? Is it entirely economic? And was the whole discussion around a peace plan for Ukraine and Russia simply lip service?
Look, I think it's both. Again, he does seem to be convinced to some extent. And again, he's repeating this morning, I think, speaking in the first person, so the French president, well, apparently thinks that he has a special touch or a special dynamic that can sway China and change things as for the better, perhaps de-escalate things in the war, and also tell Russia you need to stop it. The quote that came out of this meeting, according to the AFP, is that you're the one that can bring senses to Russia to de-escalate the situation. But again, this is not a consensus view, and I know a lot of officials behind the scenes who would tell you it's just naive. China had a year to do it, and they haven't done it. When you look at the trade, again, everyone wants to benefit from the China reopening. If you're a luxury company in Europe, frankly, you sell a bag for 10K, that is a great opportunity and not necessarily risky for Europe. We know the risky areas are technology, obviously, the chips, all of that. I think the EU really wants to get a sense of where China wants to go, but also make it clear that they want to make a separation between what is beneficial and what is risky. Can they do it? I mean, I think the judge on that remains to be seen.
Maria, doesn't Macron have big problems at home still?
Well, he has big problems, but again, remember, he is someone who loves international relations, who just lives for this. I've covered him many times. He seems to be more interested at times by the international politics, by the geopolitical conversation than his agenda at home. A lot of the everyday today base is also just a structure of the way that the French state works, goes to the prime minister. So she's the one that's having to deal with the blowback from the pension reform. And on that front, by the way, he's not backing down. He still says we are going to retire at 64. That's not changed that age. But yes, maybe you could argue he should also spend more time dealing with this.
Are you suggesting that the man from France likes to enjoy playing statesman abroad?
Well, he enjoys it. He's interested by it. He lives for it. A lot of the appeal from Emmanuel Macron by the people that voted for him, but also in Europe, is that he's someone that is genuinely interested by this, that is not just playing national politics on a daily basis and wants to insert, his point of view and his feedback on all of these big conversations. The French also, by the way, they believe they can do things that no other country does, in the extent that if you want to have a phone conversation with Vladimir Putin, the United States cannot do that. The UK will not do it either, and the Germans will obviously, with the reputation is in tatters over the Nord Stream. So again, they believe that they are what they call themselves a power of mediation, that they have this capacity to bring people around the table.
Maria, thank you. Maria Tadeo, the perspective from Brussels and maybe the Spanish
I was about to say, yeah, I think it might be
tinged. There was a style guide, I forget from which media institution in the last few months, there was a style guide, and they said you can't say the French anymore. You know, don't say insulting things like the French.
Why
and
is that insulting?
Then they had to backtrack. They had to backtrack afterwards. What did you make of that?
Well, I love Maria. Maria, you're fabulous. I will just say I love the backpedaling after she basically said Emmanuel Macron is going to play the statesman while other people at home deal with some serious unrest that we've been reading about and seeing images from. So that's basically...
The city practically burning.
Yeah, basically.
Just some amazing images coming out of Paris.
And he's going to, play the bigger role on the global stage as somebody else deals with that. I mean, look, there is this question of how much there is a tension right now between pressure that a number of different European nations are getting at home at a time when they continue giving aid to Ukraine. How do they bring an end to something that feels like it is just interminable and is a tragedy in terms of the people in Ukraine? And that, I think, is probably part of some of the accelerated negotiations.
Did you see that interview with Macron on French TV where he's discussing why the pension age needs to go up? And he's got this expensive watch on his wrist. And people suspect that he realizes that it probably isn't a good look, and his hands drop below the desk and he starts taking his watch off. Have you seen that?
No, I haven't.
That's amazing.
Oh.
You should Google that.
How'd that go over?
I mean, everyone's laughing about it. Just, out of touch leadership.
Yeah, sort of.
But he's a great statesman. Have you heard that?
Yeah, globally.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
"60 minutes away from jobless claims in America, then 24 hours away after that into payrolls." From New York City this morning, good morning. Equity futures shaping up as follows on the S&P and on the Nasdaq too. Just about unchanged on the S&P 500. On the Nasdaq down by another 0.2%. Some underperformance there actually in the last couple of days, even with a big rally in the bond market developing off the back of weaker than expected economic data. So let's check out the bond market together. 2s, 10s and 30s look a little something like this. On a 2-year down 4 or 5 basis points, 373, trading briefly in the 360s in yesterday's session. ISM services, downside surprise. ISM manufacturing, downside surprise. The ADP report, for whatever that's worth, downside surprise. Job openings, I'm old enough to remember when JOLTS, we wanted them lower. Now JOLTS, downside surprise, bad news, Lisa.
Well, it might somehow confirm this idea that we are seeing a real softening in the labor market, and this basically around the edges seems to support that, which is the reason why people care about ADP.
Let's talk about the euro just briefly. We're going to build on this in just a moment, so stay tuned for it. The optimism around Europe relative to the increasing pessimism, relatively speaking, in the United States leaves euro dollar, Lisa, at 109.11.
And we're going to talk more about this divergent story and how much further it has to go. When you talk about economic data, it's not just what's coming out of the official channels, but also specific companies. And that's the reason why I find Costco so interesting. Yesterday, they reporting a disappointing total comparable sales total for March, basically showing a decline versus an expected gain. This also comes as e-commerce sales dropped almost 13% during the 5-week retail month period. This is the concern that people have. How much are you seeing consumers pull back? How much are you going to see ongoing cost cuts as a result? And Costco shares lower by 2.6%. Target shares, perhaps in sympathy, down 0.8%. FedEx, and this is also building on that story. Those shares gaining 1.3%, building on the gains yesterday after they announced they were merging delivery networks, basically bringing FedEx Express, ground services, and other operating companies under the same umbrella. This is cost cutting. This is what happens when companies are looking for ways to increase profits and they don't see channels of growth in just economic expansion. And this is the reason why the specific companies and the earnings reports that we're about to start getting potentially could be more important, John, than any official data that we get out of the Federal Reserve or the BLS.
Morgan Stanley on FedEx, they said this: the one FedEx announcement puts the company on the path to the holy grail of integration gains. That all sounds great, doesn't it? And then you see their weighting, the equal weight weighting, and then the price target is only 180 from 145, which is below where we are right now, because they go on to say, Lisa, it will likely involve smaller steps and take longer.
And it also indicates that there aren't that many other channels for potential increased profitability other than cutting costs and trying to streamline operations.
What happened to sell on the south side?
It's a great question.
Why is it always equal weight or hold? when the price target is below where the stock is.
I'd like to see some academic studies on that. Is that like access
Yeah.
analytics?
Yeah, it's been that for forever.
Okay.
Which is just nuts also. Anyway, we promised we'd talk about Europe, so let's do that. As European equities come close to wiping out the losses from March, the former Bridgewater chief investment strategist Rebecca Patterson predicting a gloomier long-term outlook for the continent, writing in the FT recently this: even with modest reforms and potential economic support from the ECB through its transmission protection bond buying instrument, probable fiscal belt tightening next year will coincide with higher interest rates and less external growth support from both China and the United States. That seems highly probable to get many investors in Europe gloomy once again. I'm pleased to say that Rebecca Patterson joins us right now. Morning, Rebecca.
Good morning.
Not the first time we've played this game in Europe.
No,
the optimism comes back and then we get
deja
trapped.
vu all over again. Yes. I mean, I think in the case of Europe, they stalled their growth and stability pact fiscal belt tightening during the pandemic, but that's coming back into force next year. They're trying to do some fiscal reforms, but it's going to be at the edges. It's not going to be meaningful. So people will have to start belt tightening again next year. At the same time, the ECB is telling us regularly that they're not done. So we have higher interest rates. We, I'm sure, are going to get tighter lending standards in Europe, just like in the U.S., then the fiscal tightening as well. And the tools they have, it's such a mouthful, transmission bond, I need more coffee.
TPI,
but
just go with
yeah,
TPI.
Thank you. Your viewers and listeners know. So maybe those will help because it's sort of a safety net is out there, but are they going to use it? They've never used it. How is it going to work? It's an if, not a when. And then it's just China's slowing. A lot of European stocks are very globally focused. China's going to be slowing into next year after its reopening surge. The U.S. is clearly going to be slowing. So that external demand that tends to help a lot of European stocks is going to fade quickly. So I think you're just going to have a lot of factors coming together at once. That means that the rally we've seen in recent months in Europe is just not likely to persist, unfortunately.
Where does that leave the single currency? Close to 110 at the moment.
That's a great question. I think part of what's happening right now is a relative shift in interest rate expectations. The ECB staying a little more hawkish. I mean, the Fed expectations priced in the market are so all over the map. I mean, we're now looking at maybe a 50% chance of a hike in May in the United States versus 70% at the beginning of the week. So it's very, very fickle. But what gets me and what I think is hurting the dollar more is the rate cuts being priced in for the second half of this year and into next year, which I still think are unlikely. Now, if I'm right and the Fed pauses but does not cut, I think that's going to bring a measure of support to the dollar that we're not seeing right now. And if you have that happen at the same time that the economy is slowing and people are saying, give me those 5% T-bills, give me those U.S. bonds for liquidity, I think you could see more dollar strength further out. Although it's not going to be an easy call, given that the U.S. is starting from a position of a pretty big current account deficit.
I want to tie in the conversation that we had earlier this morning with Luigi Zingales of the University of Chicago, because it does introduce this real overhang of the banking stress that we've seen recently. And is it just the beginning of a banking system that cannot handle the pace of increases that the Federal Reserve has made to interest rates? Do you think that basically it is between a rock and a hard place for the Federal Reserve? If they do go through with the plan that you say, we're going to see a pretty significant recession later in the year that's going to challenge the dollar. It's going to challenge all sorts of risk assets.
Well, it's interesting when you say challenge the dollar. If we have a harder recession and that helps bring inflation down to 2 or below 2, which would be really fast. So I'm not sure that's a given. The change in rate expectations is already there, right? So that's already reflected in the dollar's current value. So I think the bias of risk is that the Fed doesn't ease as quickly. It doesn't bring the dollar down lower, which all else equal would probably be helpful for U.S. stocks. I think the trade here is not so much in the currency and the dollar as in U.S. equities. U.S. equities, I think part of the support they're getting year to date, and we know it's very much under the hood. It's a few tech stocks driving everything. But the broad support they're getting is still, I think, in part this hope springs eternal that the Fed is going to come to the rescue. And even if inflation is coming down, the pace of inflation is coming down quickly, we're still multiples above the target. So to think that we're going to get either inflation down quickly enough without more economic pain, which would flow through to earnings, or something big is going to break. You mentioned banking. If something bigger breaks and a crisis supersedes inflation for the short term, that could lead them to cut. But in either of those scenarios, it's not great news for equities. And I think it could be good news for the dollar if you see people outside the U.S. coming into the U.S. for safety, for the relative liquidity, the relative yield that we offer.
What's the threshold to cut rates? And I ask this because we're going to be talking more about political pressure, especially as we start to see the pain that we've been expecting. How high is that bar at a time when they are going to face real harsh criticism and people losing their jobs?
$1 million question. They are saying we're resolute. It has to be 2. They have to say that, right? Otherwise, they risk losing their credibility. So we don't know what the true quote unquote number is. Is it just anything below 3? Is it 2.8 but momentum towards 2? Does it have to be below 2 to get to a cut? I think it's going to depend on the broader ecosystem at the time. What are we seeing in the labor market? To your point, they call it the sacrifice ratio. How many jobs do we have to get up to get that inflation down? So I think they're going to be looking at the holistic picture, not just the inflation rate. But I do believe you could get cuts before we get to below 2. The question is it 4? Is it 3.5? I think probably not. I think it's going to have to be a 2 handle with good momentum. And again, we're just not close.
We've talked a lot in the last couple of weeks about a bond market pricing in a disinflationary bust. And then there's gold. What's going on with gold?
I love gold. I started researching gold in 1997 at JP Morgan, and then I got to trade gold during 08-09. So I've had an amazing education around gold, and gold is really complicated. I think the thing to note right now is you are seeing people saying, this is a very uncertain time. The war in Ukraine, the U.S.-China tensions, the debt ceiling, recession risk. I want to have something safe in my portfolio, even if it's only a 2 or 3% allocation. You are seeing investment demand. Turkey last year, huge investment demand, not shockingly, given what's going on with their currency and their inflation rate. The thing, though, I think is getting less attention and needs more attention is what's going on with the central banks. So you have cyclical supports for gold to the degree we have falling rate expectations, we have a falling dollar, we still have some inflation risk, uncertainty, but the structural support is the central banks. Central banks last year bought the most gold in 1 year that they've bought since the World Gold Council started tracking this in 1950. China in November and December alone bought, I believe I'm getting the number right, 62 million tons? I'm going to get the number wrong, so forget I said that. But look on World Gold Council's site. They track this stuff well. But I think the important thing is as the U.S. is maybe pushing away some of its previous friends, like they'll put it that way, there are central banks saying, how do I diversify? And Russia showed that diversifying into the Canadian dollar bonds or Australian dollar bonds, that's not good enough because they're going to work with the U.S. Gold gives them a little more room to maneuver. And so I think you're going to continue to see central bank support for gold in addition to the investment demand, jewelry demand. So we're close to an all-time high in gold. I would expect this year it's going to hit a new all-time high.
Rebecca Patterson, thank you.
You're welcome.
North of 2K, this was great. I wonder if there's some deposit flight in the mix as well with the gold trade too, Lisa.
Yeah, basically looking for a place to go to kind of hunker down. I love the historical references as to why gold was a store of value traditionally, and this idea that it required an army to kind of, protect the stores.
Yeah.
I go back to that, and I just wonder, the physicality of it. Is it going to become a liability, or is it going to be an asset that you can hold on to it? Yes, but a liability in that it's harder to transact and harder to liquidate in the same kind of way in a very different market now.
Back in Europe, we used to calculate how much it would cost to rent space in a vault and what ultimately you'd want to be in. And the Swiss used to have the highest denominated note, so you could get the most Swiss francs in a particular, say, a square meter.
Yeah.
Gold apart of that story, storage costs, all of the above. But yeah, you can spend a lot of time on this stuff.
I enjoy that.
Kind of go a bit nuts.
Instead of golf.
Brent Shuley of Northwestminster Mutual Wealth Management joins us in about 20 minutes. How dare you?
I dared.
Instead of golf.
Well, I'm just saying that's what relaxes me.
No,
storage costs.
No. Education and a commercial break coming up. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's no secret that China wasn't happy about House Speaker Kevin McCarthy meeting with Taiwan's President Tsai Ing-wen in Southern California. The country had released statements condemning the meeting, but political experts tell Bloomberg President Xi Jinping has several reasons to hold off any aggression. He's currently hosting French leader Emmanuel Macron and European Commission Ursula von der Leyen to win support for his plan to bring peace to Ukraine. There was evidence in Jerusalem for a second straight night. Palestinian worshippers barricaded themselves inside the Al-Aqsa Mosque, and Israeli police used force to remove dozens of people. Police said young people threw rocks and other objects at officers. At the same time, Palestinian militants in the Gaza Strip continued their rocket attacks on Israel. Donald Trump's presidential campaign is trying to enlist donors who have supported Florida Governor Ron DeSantis. The campaign is using polling numbers to show that the former president is an unstoppable force in the race for the Republican nomination. Now, a memo describes him as pulling away from DeSantis in voter surveys and says his indictment in New York is rallying Republicans to his side. The Biden administration is calling it the largest community solar effort in U.S. history. Vice President Kamala Harris today is announcing an agreement between Summit Ridge Energy and South Korea's Q-Cells. Now, they'll deploy solar projects that can power 140,000 homes and businesses in Illinois, Maine, and Maryland. No financial details have been released. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Donald Trump was charged with 34 felonies. He pleaded not guilty. They set a next court appearance in December, and between now and then, there'll be a whole host of motions filed by Trump's lawyers to try to either change the venue of this case and or to dismiss it. I think that the biggest problem is going to be, can Donald Trump follow the admonition of the judge to try to temper his, I guess, commentary on the case?
Michael Zowden there, the former federal prosecutor on the events of the last week, which has dominated the attention of this country. Here in New York City, the former president going from Trump Tower down towards court. That conversation was actually amazing because he talked about the legal art of making a misdemeanor a felony. And we talked about why that was peculiar coming from a DA that seemingly is intent on making felonies, misdemeanors.
Right. So you could talk about this particular district attorney and some of the criticism he's come under locally, and then pair that with the larger question. But there's a bigger issue here, which is even some people who don't love Trump are not particularly happy with this trial at a time when there are other potential legal actions, and it seems to be really helping him raise money and get sort of further in his political career. And it's interesting to see that Republicans and that Republican candidates are sort of forced to kind of rally behind him at a time when they otherwise were really critical of him. So kind of changing the scene in a big way.
Including Ron DeSantis,
yes,
governor of Florida as well, who's actually had to come out and say something in support of the former president.
Including Mitt Romney, who voted to impeach the former President Trump, coming out and criticizing this case. This has been one of the big questions. How much does this create a liability for some of the people who didn't want to see the former President Trump as the leader of the Republican Party? But then also going forward, does this mean that we're definitely going to get Joe Biden running again and potentially winning the nomination?
So John Harney of Bloomberg wrote this story up overnight, that Donald Trump's presidential campaign is trying to enlist donors who have supported the Florida governor Ron DeSantis by presenting the former president's rising poll numbers as an unstoppable force in the race for the U.S. Republican nomination. We've seen some reports about how much the Trump campaign has raised in the last week alone, the last couple of weeks. Pretty phenomenal numbers.
He's raised a lot of money and he's gotten a lot more attention, although under the radar. We've also seen other candidates start to raise quite a bit of money. So this is also something that we're heating up into a campaign season that's going to be really interesting. I just wonder how much we can dovetail what we're hearing in the theater of all of this into actual policies that need to get done in the next couple of months. And
just yesterday. I want to touch base with the markets just briefly. Equities, bonds, and foreign exchange. And start with the equity market. Really interesting developments in the last week or so. We've just had a string of weaker than expected economic data. ISM manufacturing, ISM services, downside surprises. On the job side, that's the activity data. On the job side, jobs, downside surprise. Some nuance there, but let's go with the headline for now. And move on to the ADP report. Downside surprise again, going into payrolls. We were looking for 240, now something a little south of 240,000. We'll get that payrolls data tomorrow. But it was bad news, and then bad news in the equity market in a way that we hadn't seen before, even with this in bonds.
Yeah.
A rally with yields much lower, Lisa. The 2-year, as I said repeatedly through this morning, at one point yesterday, trading in the 360s. Very close to that again now. We're down about 6 basis points on a 2-year to 371.50.
You raised the point about Mohamed El-Erian talking about how you shouldn't really be trading on every data point. And I wonder whether we are, whether we're seeing people actually trade on every data point or use data points to confirm a narrative that is the new narrative du jour. And I say that because you could look beneath the surface and come up with a narrative that you wanted that would fit, you know, the data that you're getting. But right now, we're seeing people very concerned about growth, especially in the face of some of the concerns around the banking industry. We just got challenger job cuts a little bit ago, and I mentioned that earlier. And this, to me, is interesting because it actually didn't rise as much as people thought. It rose more than 300%, but it's down from the prior reading. Are people going to look at data that does not confirm a narrative of softening? And that, I think, is really going to be an interesting takeaway from this moment.
What did Connor Sen of Bloomberg Opinion say yesterday? That this economy was guilty until proven innocent when it comes to the economic data, reflected in what's been developing in the bond market?
For now, at least with respect to the equity response to what we're seeing in bonds. Until now, we hadn't really seen that. And I think that's really an interesting shift that we've seen over the past couple of weeks, that suddenly equity markets are waking up to what bonds have been saying for quite a while, which is this Fed is going to be forced to cut rates in the face of real weakness, which is going to impede profitability.
You mentioned Mohammed. I think Mohammed would be the first to say that different seats are going to have different opinions on this. So if you're in a market seat and you get incoming information like ADP, JOLTS, the ISM, both manufacturing and services, and you see a string of downside surprises, you're going to make a move on that. Get these shifting probabilities around a potential outcome, changing every single day, and markets are going to reflect that. If you're a policymaker, have we had enough so far to make a change, to move away from the baseline? Their baseline still is get to north of 5, stay there, don't cut. That's what we want to communicate. They've had the opportunity to present in their quarterly forecast to the SEP, the summary of economic projections in the dot plot, to project all of that. Are they really going to start to make a change after a week of economic data?
April 12th, we get CPI. And what a lot of people are saying is you're going to get all of this potential weakness. It's going to drip out, and people are going to hunker down in bonds and hunker down when it comes to selling certain stocks. And then CPI is going to come back. And you're going to see that it's not really making the progress that people wanted to see. And suddenly, that'll whipsaw in the other direction because that is what the Fed is looking at. And that is the reason why they're not talking about rate cuts that the market is currently pricing in.
Well, the Fed has told us that they think, effectively they've implied this, that what's developed to some extent over the last month is going to deliver some kind of disinflationary forces, and that to some extent, and you can argue to what extent, it's a substitute for rate hikes. So once you've said that, if you start to see a deceleration in the economic data, a string of downside surprises before that story's even started to bite, then I think you start to build an argument that the Fed can back away, don't you?
Do you think that the discussion out of the Fed has been consistent? I mean, do you think that the messaging has been consistent through and through at a time of great uncertainty? I think some people would argue not so much, because you heard, we're going to keep raising rates. We're willing to take a lot of pain. We're not going to really start thinking of pausing or cutting until we see progress. Is it progress to see true stress in the banking system?
I think they've muddied the water on one particular point that they've made. I think a lot of people come on this program, and you've heard this repeatedly. Mike's talked about it. We talked about it with Mike McKee yesterday. They will say things like, you have tools to deal with financial instability, and you have tools on the monetary policy side to deal with inflation. And that's kind of intuitive, and it makes sense until you say that the financial instability and what is developing there could be a substitute for rate hikes. Then that's not two stories, that's one. And clearly, the tools on the left do shape the tools and how you use them on the right. And I think that's where they've muddied the water. So when you see Torsten Slok of Apollo, this is what we're all looking at right now. It's not payrolls tomorrow. It's not CPI next week. It's banking stress. And how much that banking stress is going to materialize into a bigger substitute for rate hikes in the future, and or maybe the rate hikes they've already done, which will have to lead them to think about reducing interest rates as well. This is what Torsten Slok of Apollo said this morning. Here's the headline. This will get your attention. The credit crunch has started. Torsten went on to say, and he referenced this, Lisa, a survey of 71 banks in the Dallas Fed district done after SVB went under shows a dramatic reversal in loan volumes. This Fed survey was carried out from March 21 to March 29th. Is that going to continue through the rest of this year?
Well, and a lot of people are saying they'd like more transparency, and that's why I think Luigi Zingales was so interesting. He said what he would like to see the Fed do is to come out and deliver a report that gives us some sense of how vulnerable some of these smaller and regional banks are and how much they're seeing real declines in their deposit base. I think it's telling that Western Alliance, one of the banks that came under some stress, those shares went down significantly on the heels of a lack of transparency around deposits and how quickly they were going down. Then yesterday late, they did reveal how much their deposits had gone down. Even though they had gone down, there still was a rally in the shares because people are looking to just understand what the scenario is, not just potentially just sell everything.
I think those deposits in the first quarter were down 11%.
Correct.
Something like that. I wonder if the experience of that bank in the last 24 hours is a lesson for the regional banks that will report in the next few weeks.
Transparency will be rewarded.
Tell us more.
Exactly.
We'll see how much they're going to tell us. Remember, First Republic scheduled, and Shonali Bassett was keen to point this out, scheduled to report earnings on the 13th. We'll see if they have to come a little bit earlier as well. Then it's on to the big players, JP Morgan, I believe, on the 14th. And as Lisa mentioned, you get CPI on April 12th. A lot coming up, including payrolls tomorrow morning, 8:30 Eastern Time. The estimate just a touch below 240,000. We'll pick up on that conversation with Brent Schutte, the CIO at Northwestern Mutual Wealth Management. Looking forward to that conversation shortly. Futures just about turning higher, positive by a little more than 1/10% on the S&P 500, and yields stay lower. This move sticks over the last couple of days. We're down another 6 basis points on a 2-year, 372 from New York City. This is Bloomberg.
Specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the don't fight the Fed mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
We're in a position where the Fed will be first in the eventual easing cycle. We don't know when.
I think the Fed is not going to cut 2.5 times by the end of this year.
I think the Fed continues to pound the table that they are concerned about inflation.
There are a lot more pressure as a recession seems more certain.
When recession starts, typically, that's when the markets bottom out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City, getting some of you towards a long weekend. Others will be looking at a payrolls report tomorrow morning. We're part of the others from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK is going to be back with us tomorrow morning for that special coverage on the jobs report. Our coverage will start here in New York at about 7 a.m. Eastern time. Equity futures right now positive by almost 0.1% on the S&P 500. The story of the week, you're familiar with it by now. Data in America, Lisa, weaker than expected.
Which is the reason why I think it's interesting if this market trades off of initial jobless claims that not so long ago were considered irrelevant and noisy and potentially flawed in the way that they were constructed. How much are people basically hinging a narrative onto data that is incomplete? And how much are people starting to look under the hood, not only at banks, but also companies like Costco that are delivering perhaps some disappointments?
The data is always about confirming the pre-existing bias, isn't it? Isn't that what it's always about? Is that new?
Sometimes there is more clarity than there has been over the past year. And in a soup, as we've been talking about for quite a while, people cling to what they can to try to give us some sort of compass. how much are we going to be looking at banks and at earnings more as a compass than some of these other backward-looking indicators that the Fed uses to craft policy?
I think we've established the bias of the last week or so. If the data's good, ignore it. It's going to get worse. And if it's bad, that's real. It's bad. That seems to be the take at the moment. And also to compare and contrast with where the data was, super resilient going into the banking stress. No landing was the phrase everyone heard. And we use that phrase really loosely. It didn't mean no landing ever. It just meant no recession at the start of the year, the way some people anticipated. And now all of a sudden it's hard landing banking stress and more stress in the banking system through the rest of this year.
Here's what I want to understand, the read through to inflation. Because if, let's say, we do get this weakness, does that bring inflation down? Is it going to be enough to really offset some of these other aspects? And if not, what do you get with respect to the political pressure and the market pressure for the Fed to move away from some of their higher rates at a time when inflation hasn't been defeated? And that's when I think it'll start to get really interesting in the bond market.
I'll keep returning to the calendar for you. Tomorrow morning, payrolls. A little bit later this morning, 27 minutes from now, jobless claims. Then on to next week on the 12th, which I believe is Wednesday, we get CPI data. For those of you interested in the banks, First Republic on the 13th, JP Morgan on the 14th. If you want the estimate for payrolls, in our survey, and I always stress it's a moving target, as the numbers change, the estimates change, and we get more new estimates, fresh estimates going into the print tomorrow, 235. That's come down a touch from 240 following the weakness we've seen develop in the economic data so far this week. 235 is the estimate. Remember the previous number, 311,000. That's the data. Here's the market. Equity futures on the S&P 500 shaping up as follows. On the S&P futures turning positive in the last hour or so, positive 0.1% on the S&P. Yields lower on a 10-year, a break of 330. On a 10-year, we're down 3 basis points to about 328. Talked a lot about the 2-year. Let's talk a little bit more about the 2-year, Lisa. We're down 6 or 7 basis points to 371. After starting the week north of 4%.
Which is the reason why I keep thinking about the Fed credibility gap. Right now, if you take a look at Fed funds futures, you're looking at a Fed rate of 3.8% by January of next year. That's down from almost 5% currently. How does that read through? At what point does this really undermine the Fed's ability to direct markets if their communications lack the oomph to actually effectuate a change in market direction?
Are there reasons to embrace the gloom? Brent Schutte joins us now, the CIO at Northwestern Mutual Wealth Management. Now, Brent, you're not usually the guy we'd go to embrace the gloom. Are you embracing the gloom?
Yes, we do think there's going to be a mild recession in the coming quarters. So I don't know if I'm embracing the gloom completely, but certainly I do think the preponderance of the data, I've heard this show this morning, continues to point to a recession. And I think that's likely to occur in the next few months. And so certainly, I suppose that's a bit gloomy. I guess the good news is that fixed income, once again, for investors is behaving as a hedge against falling equity markets. And so I think that's the good news. That's where we've been positioning more so over the past 6 months. So we have joined Team Abramowitz. And then I think there are opportunities coming out of this. I mean, there are asset classes that trade at 13 times markdown earnings that I think a mild recession will give way to something much better towards the end of the year into 2024. And that's where I think there's some optimism as we push into the future.
Brent, can you talk a little bit about the evolution of your views based on your constructive outlook, perhaps just a couple months ago, and how that's turned less constructive on risk over the past few months?
Yeah, so we've kind of categorized this time period as the space between, borrowing from a Dave Matthews Band song. And so back in October, we believed that inflation was peaking. And I still believe inflation is peaking. And to Lisa's comments earlier, I think inflation is continuing to melt, which will allow the Fed to eventually ease. But we were kind of in the space between fears. And so as inflation kind of came off the boil, you started to see the markets do better. That's why we did better into the end of the year. But we thought we were headed towards recession fears because the Fed has gone too far. And so maybe that's the change that I've had over the past few months. It's been more so that we are headed towards a recession. The preponderance of the data points that way. And we thought investors would eventually have to embrace some rougher times as the market started thinking about a recession, which I think is what you're seeing exactly right now. And that's why over the past 6 months, we've shifted more towards fixed income and lengthened our duration because we did believe once again, it was a hedge. It wasn't in 2022 because the equity market downside was caused by too much. It repriced, and we thought the equity market downside would be caused by too little, which is kind of what you're seeing right now.
Shifting into long duration, what about the short end at a time when people are pricing in rate cuts and you have a Fed saying our job isn't done?
Yeah, my big fear was that I heard a lot of investors who only wanted to hide out in the front end of the curve, and I don't know where rates are going to be in 2 years. I suspect they'll be lower. And so if you think about reinvestment risk, not only just higher yields, in which they were at the time, we wanted to embrace more the long end of the curve because the 10-year Treasury yielded 4%. Where do you think that 10-year Treasury might be in a couple years? Where do you think the 2-year Treasury might be in a couple years? And so it was more along that commentary there. And if you look over the past few months, I mean, the longer end of the curve, despite the shorter end going down, when you add in the duration there, has done better than the shorter end.
Brent, this raises a really important question about the amount of money that's gone into money market funds over the last couple of months. Do you get the sense that a lot of that, at least in the last month or so, is just about guaranteeing return of capital and not return on capital?
Yeah, I mean, this is what investors shouldn't do, which is panic. I mean, no one knows for certain what's going to happen. And the equity markets have discounted some of the recession already. If you think about it, we made our high 15 months ago. If you look at the past 11 recessions, that's the longest time period into a recession from the market peak to if it started today, which we can argue about when the recession is going to start. That's always an interesting conversation. And if you think about it, we're still 15% lower than what we were at the beginning of January of 2022, which would be the second largest decline from peak to recession start date that we've seen. And so I don't think it's all gloom. I just want to make sure that people, the way that we handle uncertainty is diversification and making small tilts around the edges. But to go all in and all out of asset classes and only invest when times are certain, that's when you lose as an individual investor.
Brent, let's talk about.
So I think people need to stay the course.
Let's talk about the index just briefly to wrap things up. You know the range, 3,800 to 4,200 over the last several months, the low back in October. Brent, when you think about that range, 38 to 42, if we were going to break through that range, would it be to the downside? Would that be your bias at the moment?
I think it'd be slightly to the downside, but again, I think it's a mild recession. On the opposite side of this, I don't think you're going to be able to completely time the upside. And so I don't think people should get too negative because you have discounted some. But I do think, yes, the S&P 500 especially has some room to the downside.
Have you developed any thoughts on where the equity leadership's going to come from if you do truly believe that maybe this bond market moment is just a moment?
I think the equity market leadership in the next cycle, this reminds me so much of 1999-2000, where large caps didn't do so well in the coming expansion that was after that recession because they were priced to perfection. I think small and mid caps, which trade at 13 times already marked down earnings, well below their historical average, a margin of safety. I think that's where the equity upside is coming out of this on the opposite side. And I know we're all negative on Europe still. I heard the commentary before. I think there still is some upside in international stocks, which have a dollar declining tailwind behind them now. Plus, they trade at low valuations also.
Brent, just quickly, the small and mid caps, there's exposure there to the financials, particularly on the Russell. Brent, is that a story you also have some faith in?
Yeah, I don't think we're in a cascading bank default. Think about what we've talked about and what it caused the downside in the banks. It was their collateral was going down. Their high quality collateral had gone down because rates had risen. Where have rates gone the last few weeks? And are the losses there as big as what they once were? I think that's a key differentiation between today and 13, 14, 15 years ago, where the collateral, where the assets weren't quality. And so I think the buffers will work. It's unfortunate that those banks just got caught in a period of time where rates were still rising and those mark-to-market losses were large because of that.
Brent, this was wonderful. It's great to get your insight. Brent Schutte there of Northwestern Mutual. Not a perma bear. It's interesting to hear someone who's usually constructive come out and say, you know what, got to acknowledge where the data's going and it's getting weaker.
And that's the reason why people have increasingly perhaps moved away from just buying every dip, and you're starting to see that change in behavior. I wonder if diversification now goes back to meaning bonds and stocks, or whether it changes and diversification is something slightly different, a different mix of stocks or a different mix of bonds. And that, to me, is going to be the theme coming out of this year. How much have we actually moved away from the broad benchmark indexes?
Moved away from the S&P 500. Just hug it and hold it and look at the gains month after month after month for 10 years.
That's exactly it.
I know.
And that's what we've got for earlier this year. Yeah, it was only 20 stocks, but if you got those 20 stocks right, great, good for you. But otherwise, if you hugged the index, you were golden.
Well, this is why the leadership story is so important, because of the member weighting of the big tech players, the mega cap stocks. The leadership question is vital. I don't know if we can answer it yet. And also, I think a lot of people think that that answer depends on what will develop in the bond market. If we do get a Fed that gets to 4 or 5% and stays there and doesn't go back to the old days, then maybe it's going to be difficult to get back to the days of tech outperforming and the NASDAQ ripping. But to your point, as we've seen through the year so far, year to date, what's winning?
Exactly, big tech. And that's come on the heels of, at one point, higher rates, and now you're seeing an underperformance. But honestly, if people really believe that something is breaking and that this banking system cannot handle the pace of the hikes that we've seen to date, well, that would kind of support going back to a lower rate, at least in the near future, for a little bit.
There's certainly some evidence that some banks are struggling to deal with rates of 4 or 5% from zero a little more than 12 months ago. So this is what we're going to do in the next 20 minutes. Jobless claims come out. Lisa's going to break down that information for you. She'll catch up with Carl Riccadonna of BNP Paribas. Look out for that conversation. Before we get there, Speaker McCarthy catching up with Bloomberg's Anne-Marie. We'll catch up with AMH in just a moment.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Beijing, France's President Emmanuel Macron urged Xi Jinping to use his influence to help restore peace to Ukraine. He said that China's president could bring Russia, quote, back to reason and end the fighting. Xi has sought to rally international support for a vague peace plan. The U.S. has dismissed the idea, but France has welcomed China's effort. House Speaker Kevin McCarthy says that China can't dictate who he meets with. McCarthy spoke with Bloomberg after meeting with Taiwan's President Tsai Ing-wen in Southern California. The gathering included both Republicans and Democratic lawmakers. McCarthy says he would like the U.S. to speed up arms sales to Taiwan. Meanwhile, McCarthy has a warning for Wall Street. You should worry about the political impasse over raising the debt ceiling. McCarthy told Bloomberg he's very concerned about reaching a deal with Democrats, but he's still opposed to increasing the nation's debt limit without curbing government spending. Airbus will double its production of its best-selling single-aisle jet in China. It's a bold bet on future demand for air travel and aircraft orders in one of the world's biggest aviation markets. The move in China is a key part of Airbus's plan to increase production of the A320. And in Texas, the threat of more blackouts has prompted state Senate Republicans to take action. They've pushed through a plan that could compel residents and businesses to fund a fleet of new natural gas-fired power plants. Now, lawmakers want to avoid a repeat of the deadly week-long grid collapse during a historic freeze in 2021. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Friday, we zero in on March jobs.
A much anticipated jobs report.
The data are lagging and they are all over the place.
Fed tightening has consequences.
This Friday, it's a special Good Friday edition of Bloomberg Surveillance starting at 7 a.m.
What's the tea leaf I should be watching?
Do you think that this is an accurate response to the report that we just got?
You can't react to every bit of data.
The special Good Friday edition of Bloomberg Surveillance, Friday starting at 7 a.m. Eastern, leading up to the jobs report at 8:30.
We've never spoken
with one voice when it comes to China. We've gone from administration to administration. So when I became Speaker, we created this select committee and had 146 Democrats vote for it. You've watched Democrats and Republicans here together. I think that would even foster a stronger relationship with China because China would understand where our boundaries are. They won't worry about, oh, one party saying something.
I'm really lucky to work with some people who work just tremendously hard and fly around the country to bring you interviews like that. AMH went from New York over to California and then back to Washington in something like 48 hours, Lisa, something like that.
And she did great work. And she got an interview with someone who really has a leadership role after a very hard-fought battle at a time of bipartisan support for increasing tensions with China.
On several issues, not just that one. House Speaker Kevin McCarthy speaking with Bloomberg's Anne-Marie. AMH joins us right now. Anne-Marie, great work, fantastic conversation. I caught much of it yesterday. Let's build on it. Your big takeaway.
Well, one is for sure that Speaker McCarthy wanted to show a bipartisan response, really, in this action against China and standing up with Taiwan. Even when he was meeting with the press after, he wouldn't talk about former President Donald Trump when questions were asked about him, or current President Biden. He said, no, we're here to talk about what this bipartisan group of lawmakers are going to do in response to Taiwan. And those things, he said, is he wants quicker ammunition and the weaponry that is being supplied to Taiwan. He wants to make sure there's the easing of the backlogs. And he wants to be able to say that this Congress is speaking with one voice. And he's really trying to trumpet the House China Select Committee. This is something that this Select Committee looks at major issues when it comes to China and then will give advice on how Congress should act. So this is one of his biggest plays into foreign policy since he's been Speaker, and he really wanted to show that he was not changing policy. Some of his members want actually the U.S. to change, not to have this ambiguous one China policy, but more strategic clarity. He wasn't doing any of that. Definitely in terms of towing the U.S. administration line, he came into terms with that, but also wanted to make it clear that this was a bipartisan delegation.
Anne-Marie, is there anything to learn from how China responded to this meeting and how they responded 12 months ago to the meeting between the same leader and Speaker Pelosi at the time?
Well, we already saw an aircraft battle tanks go into the southeastern seas of Taiwan. Also, there was reporting that they were now inspecting maritime cargoes going across the Taiwan Strait. But this is a very muted response compared to when Speaker Pelosi made her trip last summer. We have never seen anything like what we saw in the response of her trip last summer, including a missile flying over Taiwan. And that was by design. Washington really wanted to make sure, as well as Taipei, that there was not going to be a recurrence of what we saw with Speaker Pelosi's trip to Taipei. And that is why this meeting took place in Southern California at the Reagan Library on U.S. soil. One thing that was very interesting, reading some of the tea leaves, everyone had something to say about this meeting yesterday. The White House was saying that Tsai Ing-wen, Taiwan's leader, was just, quote unquote, transiting through. But Speaker Pelosi, rare praise from her to the current Speaker, Kevin McCarthy, saying that the meeting is to be commended for its leadership, its bipartisan participation, and its distinguished and historic venue. Very interesting comments from the former speaker to the current speaker, and they didn't always get along.
Yeah, to put it mildly, and in her backyard where the meeting was taking place. I wanted to turn to some of the other issues that you talked about with him, including the debt ceiling. With Kevin McCarthy sending a message to Wall Street, you should be a lot more worried than you are. How hard is his line on not lifting the debt limit, on possibly not negotiating on the terms that have been laid out?
Well, what I took away from that conversation is not just putting Wall Street on guard, which you should be very concerned, he's also putting the White House on guard. He wouldn't give details of this proposed bill that he wants to get through the House, but he said, I may have news for you when we come back from recess later this month, when Congress is back in session. The idea here is that the White House has been trying to almost divide and conquer. They are saying we will not negotiate fiscal spending cuts when it comes to the debt ceiling. It must be a clean debt ceiling lift, as it has been 3 times under the former administration. And what Speaker McCarthy was insinuating to me yesterday is that they plan to have this bill hit the floor. Now, this bill, if it gets through the House, will obviously only have Republican votes and has no life in a democratically controlled Senate. But what it does show to the White House is that McCarthy has his members in line and that they will not budge, and that what he really wants is another conversation with the president.
Well, I want to pick up on that. It has his members in line. At some point, he had to give up quite a bit of power to have the position he has. How surprised are analysts that he has been able to consolidate the Republicans around unified views, considering the fight that it took to get him there?
Well, this is where the tension is. The White House does not think, or the strategy is they don't think he's going to be able to do it, given the 15-round votes it took to get him to the speaker podium. What he is signaling is that he thinks he will be able to have his members in line. But remember, there's going to be a lot of negotiations within the Republican Party in the House, because there is a wide spectrum on how they should view the spending cuts, what they want to see in lieu of their votes to raise the debt ceiling. So this is what he wants to do, but we haven't seen it yet. We haven't seen that bill hit the floor.
Anne-Marie, these are 2 points then. China, Taiwan, you've talked about that. Debt ceiling debate, you've talked about that. What does Speaker McCarthy have to say about what's happened with the former president this week?
Well, he says this is politically motivated, and he said it's not just Republicans. He mentioned the former governor of New York, Cuomo, as someone who also thinks this is politically motivated. Obviously, what you've seen from the former president is very divided, hardening these partisan lines. I did ask him, though, if he would support more people coming into the Republican candidacy to run for the 2024 bid. He deflected, and he said, well, we haven't even seen Biden announce his candidacy yet. What are the Democrats doing? But that's not your party, Mr. Speaker. But he basically insinuated that he is always for democracy, but he wouldn't say whether or not he wanted to see a challenger to the current president. And obviously what we know is that, the former president right now is leading in the polls and is campaigning a ton, north of $8 million or $10 million, the last figure from his campaign, on how much he has been making in donations since the news of his indictment came about.
Anne-Marie, did you get the sense that Kevin McCarthy was somewhat frustrated at the energy that it was taking and the focus that it was taking off some of the other issues and the consolidation that he had gotten around the Republican Party?
Well, he didn't say that, but I think it is fair to say that yesterday in Southern California, there was a pretty big group of reporters, especially international reporters there. But the day before, when I was in Southern Manhattan, it was blocks long of reporters. I've actually never seen so much press in my entire life outside the New York State Supreme Court on Center Street. And I think what that signals to me is what I think it signals to a lot of people, that once the former president has a huge story around him, he takes the oxygen out of the room. And he's doing that as well in Washington.
AMH, great coverage. Looking forward to continuing this conversation in the next hour as well. Bloomberg's Anne-Marie Hordern on her interview, her conversation with the Speaker of the House. Lisa, clearly it's taken away a lot of oxygen from some other big issues down in Washington.
And other people who would otherwise be potential leaders in the Republican Party. This is what people are talking about instead of the debt limit that everybody just shrugs off and assumes they'll try to fix, and they'll get it done at the last minute. And yet I do wonder under the hood how much frustration there is among a number of different political operatives saying, we wish we could just get back to what we have to do in Washington.
You remember Operation Biden for the campaign in 2020? It was sit back, do nothing, and let the president, at the time, President Donald Trump, take the airwaves. Sit back, do nothing, and hope, because I believe this, I think others do too, that this is the guy he wants to run against. I mean, without a doubt.
The polls bear that out, that if it is a matchup of President Biden and former President Trump, that President Biden has the massive upper hand on winning the general election, which has got to be creating some agita among a number of Republicans who both want to come out and support, but also want to win.
Jobless claims, 5 minutes away. Torsten Slock of Apollo, Troy Gayeski of FS Investments, Cameron Dawson of New Edge Wealth joining us in the next hour on Bloomberg TV. Elise is going to run you through the latest data just ahead.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Breaking down in bond yields, breaking down in stock futures, 30 minutes ahead of what we get with respect to an additional bunch of data just minutes away from the latest initial jobless claims here. If we want to walk you through some of the data, we are seeing the NASDAQ continuing to underperform the S&P at a time when people really are wondering if bad news is bad news. The S&P just slightly down, but yields sharply lower. If you take a look at a 10-year yield, 3.25%. Taking a look at the economic data as it crosses with initial jobless claims front and center after yesterday's disappointments with respect to the ADP payrolls, as well as what we saw with the JOLT survey, a confirmation from initial jobless claims, which actually rose to some of the highest levels that we've seen in a while. 228,000 reported initial jobless claims, up from 198,000 the month before. If you take a look at continuing claims, they also rose to 1.8 million from 1.68 million. So again, if you're looking for some sense that the labor market is softening, you are getting it in some of the anecdotal data. If you take a look at markets, you are going to get a response from that, because this basically confirms the narrative that we have been seeing. Taking a look at yields right now, you could see 2-year yields just a touch lower, and you could see it now at 3.7%, and you could see 10-year yields as well following suit. I am so glad to help me break this all down. Carl Riccadonna, Markets 360 Chief U.S. Economist at BNP Paribas. Carl, wonderful to see you in studio. Your first take on the importance of some of this just drumbeat of data pointing to a softer labor market.
Well, as I was thinking about the data dropping before I walked on set, I thought, well, you know, the rule of thumb is if claims move up by about 10% over the prior quarter average, that's often kind of an alarming signal that you're heading towards recession. So as I was guessing in my mind, well, what would that be? I was thinking about 230,000. So we're pretty much right there at the kind of level that gets outside of any kind of noise and starts to be more of a meaningful signal of some problems. Now, the big debate is whether it's a slowdown or a hard stop. I don't think this is hard stop evidence just yet. Also, I'm just extra sensitive around interpreting jobless claims in the weeks around the Easter holiday, basically, because that's when school spring breaks happen, and often we see these kind of one-off spikes or dips in claims that get ironed out in the subsequent weeks. So if we're holding at these kinds of levels for a couple of weeks and there's not a retracement, then that would be more alarming to me that we are starting to see the real deterioration in labor conditions that could be pushing us to a much weaker pace of economic activity.
Is that enough for the Federal Reserve to really perhaps cut rates, considering that they've been targeting inflation, and this doesn't speak necessarily to progress in the inflation fight?
Well, there's some progress in the inflation fight, but it depends where you look. And if you look at the part of the inflation basket that really matters to the Fed, so core inflation, and then let's narrow it even further and look at core services, you're not seeing improvement to any material degree on that front yet. And that is what is haunting Fed policymakers in the backs of their minds as they realize that is what has to break to really be back on a path towards a sustainable path towards 2%. We are not seeing that in the data. Now, if the labor market is slowing, that is a key factor that we need to see to move in that direction. But again, 1 week in jobless claims is not there. We saw some cracks in the facade in the last jobs report. You saw finance actually looking pretty weak. You saw manufacturing starting to look weak as well. And so I think those trends will continue. It's not necessarily that tomorrow's jobs report is going to be the key one, right? The survey week was actually the same week that we had all the stresses in mid-March in the banking sector. I think it'll take a month or two for that fallout to really start to show up in the economic data. But the direction of travel is pretty clear here.
When we talk about what we got in terms of the past week, I want to also talk about revisions. We just got those as well. They just populated 246,000. It was revised upward from 198,000. The total number of continuing claims also revised upward from last week from 1.68 million to 1.8 million. So this is a couple weeks in a row now that there is an elevated number of initial jobless claims. Is that significant for you, that the upward revisions are now to the wrong side that we're seeing in U.S. economic data?
You highlighted the Economic Data Surprise Index earlier on the show, and I think that does tell us something about what's happening to the data and how forecasters are thinking about the data, right? So, there is a moment. We've had this extended stretch where non-farm payrolls continue to surprise relative to consensus expectations, and it's been going on for many, many months now. Eventually, it's going to have to go in the other direction, and I think we're getting close to that point. Again, I think things were too fast-moving in March for this to really show up in tomorrow's payroll print, but I think we will see it much more evident in the second quarter.
Okay, you say what we saw in March.
And actually, before we move on, if we can stick with the theme of data and revisions, something that I think slipped under the radar screen last Thursday was the third print on Q4 GDP, which everyone says it's the third print. Why pay attention to it? But in Q4, that's our first look at economy-wide corporate profits, and it's a pretty uncomfortable trend that we see in the economy-wide corporate profits data. A year ago, it was growing something like 20%, 22% year on year. In the last quarter, it contracted by about 2% in the fourth quarter. So it's only growing 2% year on year. So a big deceleration, and that profit trend drives hiring, it drives investment, it drives business decision making.
Right now you can see equity futures lower after that data, just marginally lower for the S&P, but futures on the NASDAQ you can see lower by about 0.4%. From your perspective, you said March, the events that we saw last month, I imagine you're talking about Silicon Valley Bank and some of the bank fissures that we saw. How much do you think that really did change the landscape and accelerate the potential downturn that this economy could see?
Well, we know it's creating some tightening of financial conditions or credit conditions in the economy, and it's going to take some time for that to actually show up in the real macro data. So all eyes are on the Q1 Senior Lending Officer Opinion Survey, the SLOOS. Unfortunately, we don't get that until after the Fed meeting, unless they decided to publish it early. But we'll get little glimpses of what the SLOOS could look like. There was some survey data out of the Dallas Fed earlier this morning. Also, we have bank earnings seasons basically starting next Friday, and then the week after that, continuing with a lot of the regional banks reporting. And so probably from those earnings calls and the tone of the discussions, we might get little glimpses of what that SLOOS will ultimately look like in early May.
How much are you looking at those types of surveys and official data? And how much are you looking at corporate earnings in a way that you hadn't before? Not just the numbers, but also the guidance that you're getting from corporate executives, seeing things moving in real time and confidence deteriorating pretty quickly.
In a fast-moving, fluid environment, often the macro data is slow to catch up, and so you have to pay attention on what is the driver of the narrative at the moment. And at the moment, it is that stress in kind of mid-tier and smaller regional banks that really is the primary focus. And so that kind of anecdotal data, whether it's the beige book, whether it's bank earnings calls, or just simply reporting in the newspaper and on the Bloomberg terminal about what's happening in those sectors, really becomes that much more important. And that's true for Fed officials, it's true for Fed watchers, it's true for market participants.
Given some of the shifts that we've seen over the past few weeks, how much have you changed your view for this year?
So, in light of the banking stresses, we had, I agree with Chair Powell's general assessment that now bank credit tightening will do some of the work for the Fed. And so as we modeled that out, basically we came to the conclusion it was equivalent to about 50 basis points of tightening. So we had a terminal funds call of 575. We dialed that back to 525 in light of that kind of, looking at through a couple of different modeling exercises. But one simple way is to look at financial conditions and kind of what has happened in the fallout of SVB. And what's interesting to note here is that a lot of that tightening has backtracked. Right, about half of the tightening of financial conditions has unwound in the weeks afterwards, where we saw this is not a giant systemic problem that is really, echoing the scary tones of 2008, but rather it could prove to be an isolated or a relatively isolated incident. So there are long-term consequences. Banks are acting more cautiously. I think we'll see that as a key theme during earnings season. But we have to be careful not to interpret what's happening.
So what's the read-through in terms of the real economy and what kind of downturn the economy could enter later this year?
Well, let's go back to the beginning of our discussion, which was that core service inflation is not showing improvement, and we shouldn't expect it to show improvement until we see some softening in labor conditions. It's very unlikely that we can walk the tight wire, the very narrow path to get to a soft landing in this environment, especially now that we're saying, banks are doing some of the tightening for the Fed. It was hard enough to understand the long and variable lag from the Fed, let alone now when we have this kind of phantom factor, which is this tightening of bank credit conditions. So our view is that really to get inflation from the levels they're at down towards a 2% path really will take a recession in the economy to loosen those labor conditions. You see hints of that today. Yeah. I'm not saying we're there yet. Our view is more that recession would be a second half of the year story. That said, Q2, we're looking for GDP growth of about 1%. So it's a growth recession ahead of a recession. It will start to feel increasingly recessionary. We see it in this week's claims data. You saw it in the ISM. You saw it in the manufacturing ISM. It's just going to, I think, continue to snowball.
And just if you're just joining, just to reiterate, we did see an upside surprise in the initial jobless claims for the past week of 228,000. The interesting thing is we also saw an upside revision to the prior week. And I keep going back to this because it's substantial. We're talking almost 50,000 jobs that were not accounted for in terms of initial jobless claims last week that was revised and put into the data. So just a sense of ongoing softening. You talked a little bit, Carl, about how it's going to feel painful and the soft landing concept is really not in the cards right now. What is a historical analog in terms of periods of time that we can look to for some sort of template of what this downturn will look like?
Well, that's actually a very interesting point that I was hoping you'd bring up. And I think the maybe interesting parallel is continental Illinois. And you're saying, what? You're wrinkling your brow. And for good reason, right? Continental Illinois was a bank failure in 1984. It was the biggest bank failure in U.S. history up to Washington Mutual in 2008. And of course, as you know, there was no Great Recession in 1985 or 86, right? We went on till 1991 before there was a recession. So John yesterday on the show was talking about the long and variable lag of banking crises or banking stresses as opposed to monetary policy. And I think that's very important. People don't remember continental Illinois. The Fed continued tightening, raising the interest rate after the fact, and the economy did not succumb into recession. So when everyone is just universally saying we're heading into recession because of the banking stresses, then we have to put on our contrarian hat and just think a little bit more creatively. But that episode tells you it's not fait accompli that we're heading into recession. That being said, even before the bank stresses, our view was the Fed is, whether it's the banks doing it or the Fed, we have to tighten policy to a point where we start to break the labor market, and that is recessionary.
Carl Riccadonna, wonderful as always. Thank you so much. It's been too long. Carl Riccadonna of BNP Paribas. We always appreciate his insights. Coming up, we've got John Gates, CEO of Americas in JLL, talking about commercial real estate. And tomorrow we will be here for Jobs Day special. We have it starts at 7 a.m. Priya Misra of TD Securities, Ellen Zentner of Morgan Stanley, Randy Krosner, formerly of the Fed, and Mohamed El-Arian of Bloomberg Opinion. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, it's no secret that China wasn't happy about House Speaker Kevin McCarthy meeting with Taiwan's President Tsai Ing-wen in Southern California. The country had released statements condemning the meeting, but political experts tell Bloomberg that President Xi Jinping has several reasons to hold off on any aggression. He's currently hosting French leader Emmanuel Macron and European Commission Ursula von der Leyen to win his support for his plan to bring peace to Ukraine. In France, unions are leading another round of strikes and protests against President Emmanuel Macron's pension reform. The bill to raise France's minimum retirement age from 64 to 62 has already passed Parliament, but unions are betting they can still force a U-turn. There was violence in Jerusalem for a second straight night. Palestinian worshippers barricaded themselves inside the Al-Aqsa Mosque, and Israeli police used force to remove dozens of people. Police said young people threw rocks and other objects at officers. At the same time, Palestinian militants in the Gaza Strip continued their rocket attacks on Israel. Donald Trump's presidential campaign is trying to enlist donors who have supported Florida Governor Ron DeSantis. The campaign is using polling numbers to show that the former president is an unstoppable force in the race for the Republican nomination. A memo describes him as pulling away from DeSantis in voter surveys and says his indictment in New York is rallying Republicans to his side. And shares of Costco are lower. A second straight slowdown in a key sales gauge led to doubts about the strength of American consumers. Costco's U.S. comparable sales rose just 0.9% in March after excluding the impact of changes in gasoline prices. It was the slowest sales growth in almost 3 years. I'm Lisa Mateo.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
My knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
If you look at Silicon Valley Bank, I don't think that they have a return on assets that justify a higher deposits. That's the conundrum. If the problem were solved simply by increasing rates, it would be easy, but they cannot afford to.
So you're saying this banking system does not work with rates of 4% plus? Is that basically what you're saying?
Yes.
If you missed that conversation, go back and watch it. It was fantastic with Luigi Zingales, professor of finance at the University of Chicago Booth School of Business, talking about the consequences of the rapid pace of rate hikes, the absolute level of rate hikes, and now what we see in a regional banking system that seems to be coming under significant pressure. As we talk about all of this, it really has been commercial real estate that keeps getting the attention. Is this going to be the next shoe to drop, especially because some of these regional banks account for so much of the lending in this space? We have to get some expert views rather than just sort of Armageddon discussions. And John Gates actually has an on-the-ground look at what is going on in the commercial real estate market, CEO of America's Markets at JLL. John, thank you so much for being with us. I want to start just letting you kind of set the stage in what you think has been perhaps misinformation as people talk about potential Armageddon, or whether it's actually accurately reflected your feeling about what's to come.
Well, when we talk about the commercial real estate sector, I think we should talk in two parts, I guess. Leasing activity, which is what tenants are actually doing, and then owning the assets. So that would be sales activity and refinancing activity. And they don't necessarily work in lockstep. So we have a much higher cost of capital today than we did a year ago, and certainly a year and a half ago. And we did have a couple of bank failures, which obviously gives everyone pause. The reality with commercial assets, then, office assets have been less in favor versus other asset classes over the last several years for a couple of reasons. The remote work factor has been a part of that. And then with increased cost of capital, loan to value ratios rise almost automatically. So asset values have fallen back, certainly across a couple of the asset classes. And that makes it harder to refinance buildings. It makes it harder to reset values, and trading activity slows down. Leasing activity has pulled back for sure, but I think that has much more to do with the underlying economy. Again, high inflation, high interest rates, so less economic activity overall and less investment activity.
It also has to do partly, I'm sure, with the long nature of some of these leasing agreements, which may not reflect in real time some of the changes in the financing conditions. John, you talked about some of the expected weakness, particularly in the office commercial real estate space. How much are you anticipating in terms of declines in valuations from where we are now?
Well, it's hard to say overall how much it will be, but definitely a pullback in office values because money costs more. So the price of money went up, and so the value of the assets goes down. And it's also been impacted by leasing activity. Newer office product, there's a brand new office building going up outside my window. The leasing activity is actually much better there than it is in anything older. So as we've returned to more normal work activities, there's been a flight to quality, if you will, in newer. And so those asset values, rents are much higher in those newer assets. So those values will hold up candidly quite a bit better than older assets.
John, you talk about how things normalize in terms of the work environment. And earlier you were talking about the whole work from home trend. Can you give us a sense of what the new work landscape looks like, especially given your insight from a leasing perspective? How much are businesses shifting back to an in-office model versus sticking with some sort of work from home hybrid?
Quite a bit, actually. The thing is, the work from home phenomena hit us like a wall. It all happened on almost the same day. And so for a while, a lot of us expected us to return as an event, if you will. And that's not what's happened at all. It's been a trend line. And it's been faster than a trickle, but it's been very methodical, and it rises almost on a monthly basis. And so we've seen that continue. That gets a little confused right now because it's a difficult economic environment. So in office jobs, hiring has declined, and in fact, it's turned down. We've seen some sectors, a lot of technology companies have announced layoffs. So leasing activity declines because hiring activity has declined dramatically, but returning to the office has continued to trickle up. The Americas actually lags the rest of the world. Europe is 70 to 80% of pre-pandemic levels, and Asia is close to that. And we've been over 50%, and you've seen certain industries announce we're going to have much more working in the office. So that trend continues. Overall economic activity pulls back and can maybe kind of confuse the data, if you will.
Do you think that leasing rates will drop and that will actually entice more companies to boost perhaps the return to office view? Or do you think that that's irrelevant and that people will keep paying really high rates for the premium properties and leave the others just empty?
We have seen more of the latter, candidly. The office leasing activity that has happened has been concentrated in newer, more expensive buildings that have amenities to offer and other conveniences. And so volume there has been much better than in the older product. And when demand diminishes, yes, supply has to reprice. And so you would see rents and economics declining there. And much more likely to hold steady, if you will, with the newer office product.
So what is the carnage going to look like, John, if there is this two-tier system emerging with the top tier of office space really getting a lot more attention and frankly garnering higher rates, and then the lower tier not getting clients, not getting people to fill the space, and also not getting financing from banks that are basically, in many cases, off the market? Are we just going to see empty cities of office space that is unfillable?
We see more of it than we want for now, for sure, and it's a great question. One of the things that's happening in our industry is reevaluating or repurposing some of those office assets. So if you look at certain submarkets, downtown Los Angeles has been quiet, but every urban area in the United States has a lack of affordable housing. So which of these assets could be well positioned to be multifamily assets, just as an example? That's a question a lot of people are asking, and there's a lot of work being done around that. Hospitality is another possibility, ground floor retail. That'll take quite some time to do, but I do think you'll see a fair amount of it happening, and it'll change the nature of some of these urban environments. Housing activity brings people, obviously, that brings retail activity, it brings street level activity, it creates a dynamism that's really a good thing, but it doesn't happen overnight. And I think we'll see more and more of that happen over, the next, you just call it 5 to 7 years.
But this is really expensive. I mean, especially given the lack of windows on these huge floors that really are not cut out for being split up into apartments. How much financing is available for these projects in properties that aren't that attractive otherwise?
Yeah, so some of the assets, to your point, don't really lend themselves to that because they're very deep on the inside or window lines and things of that nature. But some of them do convert, but yes, you have to see a reset in values because that's very a capital intensive thing. So if we thought an asset might be worth this to be repositioned as multi or hospitality, you're going to have to reset the value at something in many cases materially lower than that to attract the capital then to invest in it and do it. So yes, that process is occurring.
John, you've been in this business of commercial real estate for decades, for about 3 decades. Have you ever seen
really lower than that to attract the capital then to invest in it and do it? So yes, that process is occurring.
John, you've been in this business of commercial real estate for decades, for about 3 decades. Have you ever seen a period of time where there was this much angst and justifiable angst around the industry?
For different reasons, but probably. I mean, all down cycles are different. I mean, that's part of the reason we have them is because we don't see them coming. So if you went all the way back to the dot-com reset, there was a massive amount of commercial property that was on the market. I remember the individual that ran the Silicon Valley, Northern California from Tony he's like, we've got space forever. We'll never fill it. And of course, technology reacts very quickly. And when they go back into growth mode, of course, all that office space got released. And we went from panic mode to this is a healthy market environment. So if I was smart enough to predict exactly what will happen and when, I would tell you, but I do think the industry will be fine. We have more and more of corporate America and global corporates saying we're a better company if we're back in the office working together and engaging as teams, and you have the spontaneity and the creativity that happens. So that trend line will continue, and I think the sector will be okay, but there will be some office product, older product that's going to be repositioned. I think maybe in some extreme cases, you might even see stuff demolished and rebuilt. And it'll take a while for that to happen. But I think office buildings are here to stay and the future will be okay.
John Gates of JLL, thank you so much for being with us. Have a wonderful holiday. Coming up on Bloomberg Television at 10 a.m. Eastern, Kristalina Georgieva, Managing Director of the IMF, our own Tom Keene down in Washington, D.C., in conversation with her ahead of the meetings that we will have and that we will be at next week. In the markets, you are seeing softness led by the NASDAQ, down almost 0.5%. The S&P now directly negative, down almost 0.2%, and yields lower on the heels of disappointing data yet again coming out of the labor market with a rise, an unexpected rise in initial jobless claims. From New York, this is Bloomberg.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Following the wrong kind of upside surprise on jobless claims, live from New York City this morning. Good morning, good morning. Equity futures negative 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the economic data misses are piling up. Amazon and Google struggling to fire workers in Europe, and the Trump campaign making a move for DeSantis donors. We begin with the big issue. Is bad news just bad news?
We're entering a period of higher economic volatility.
ISM manufacturing, we just had come out a couple of days ago. It's below 50 for 5 months running now.
We see the cracks appearing.
We're in a slowing economy.
Bond market's definitely telling you that this economic weakness is legit.
The question is how much is that is embedded already in stock prices, and I think that's a different story.
It's just this constant sort of trade-off.
We keep throwing bad news at the market.
Waves of bad news, reaction to bad news that's meant to deal with then more bad news.
The day of reckoning keeps getting delayed.
The Fed is not going to bail you out. The economy is not going to bail you out.
It will impact earnings. It's just a question of when.
You can't make numbers. It's going to be a very, very difficult period.
And the IMF with more bad news. This comes from the IMF, warning that the global 5-year growth outlook will be the weakest since 1990. Let's put some numbers on that. Their outlook suggesting GDP will grow 3% over 5 years versus a 5-year average of the past 20 years of 3.8%. Let's discuss some of that bad news with Apollo's Torsten Slok, Troy Gajewski of FS Investments. Gents, great to be with you. I've got to start with you, Troy. The data so far this week, ISM Manufacturing Services, downside surprise. JOLTS ADP on the job side of things, downside surprise. Claims, the wrong kind of upside surprise. Troy, do you think there's something to worry about here?
Without a doubt, John. I mean, this brief period of euphoria in markets where equity investors, at least from a narrative standpoint, were justifying a bear market rally because the economy was going to weaken. We had a mini banking crisis. The Fed had briefly aborted quantitative tightening, and then that was going to lead to lower rates and a great outcome for earnings and revenue. Is now being dispelled by the fact that, most importantly, the labor market is starting to show signs of meaningful weakness outside of tech and financial services, which is obviously a lagging indicator. And without the labor market staying this tight, it's virtually impossible to avoid a recessionary outcome at this point.
Torsten, what a year we've had together already. Our conversations have gone from soft landing, no landing, to hard landing. This morning, Torsten, you wrote, the credit crunch has started. It's quite an emphatic headline, Torsten. What's behind it?
So the Dallas Fed surveys 71 banks and credit unions in the Fed district. And what the data shows is that this was done from the period of 21st of March to the 29th of March, that during that period, loan volumes actually turned quite significantly down. So another way of looking at that is that we're still waiting for the senior loan officer survey from the Fed, which comes out on May the 8th. But in the meantime, this is the first piece of evidence that there's now more signs of a credit crunch that has already started because of the regional banks. Remember, as usual, the regional banks account for 40% of all loans outstanding in the banking sector. So it's not a surprise that the banking sector is beginning to pull back.
Torsten, one question I've asked through this week so far is, what are the long and variable lags of a banking shock? Are we going to find out there pretty quick, pretty short?
Absolutely. I mean, as you and I also have talked about several times, we were already in the process of going through the lagged effects of Fed hikes, and now we're adding on to that banking crisis. So another way of looking at this, also to what Troy just said, think about it. What is the Fed trying to achieve? The Fed is trying to slow down consumption. The Fed is trying to slow down hiring. The Fed is trying to slow down CapEx spending. So therefore, it should have real consequences. In other words, it should show up in GDP growth, in consumer spending, and ultimately in earnings.
Troy, May 3rd, Federal Reserve meets, makes a decision. Is May 3rd too soon to have conclusive evidence of everything that Torsten's talking about?
It's not too soon because there's been enough data deterioration to indicate that the probability of recession has gone up dramatically. And to Torsten's point, that risk has been pulled forward and magnified. However, we still think the Fed will more than likely hike by 25 basis points. And then from there, it's anyone's guess, right? If the data continues to deteriorate rapidly, you keep getting negative surprises, not only in hard data, but also in the labor market, then they'll probably pause, keep it there for 6 to 9 months. And the soonest we could see them cutting is late 23, early 24. And then the other key part of that, John, is remember that the pace of the next cutting cycle will be much more modest than what we've seen recently. It'll really be the mirror image of the 15 to 18 hiking cycle, as the Fed will need to be convinced that the trajectory of inflation is heading back to 2. And then unfortunately, there's a reasonable probability it drops below that.
So let's build on that. Let's talk about that spread between market pricing and where the Fed is right now. Torsten, that spread was just as wide earlier this year, and that spread was reconciled with the market coming up towards the Federal Reserve. So now we've got the market pricing in the cuts all over again, and the Federal Reserve saying we're going to go to 5.1%, something like that. We're going to stay there through to year end. Do you suspect then, Torsten, based on what you anticipate, that this market is going to stay where it is and this Fed's going to have to come down to the market this time?
You're right. It was the market because of the no landing. The data just didn't slow down. We all came into this year expecting a recession, and it just didn't happen. And now we have added on to the outlook a banking crisis that is now increasing the risk of a recession. So now it is more likely what you're saying, John, namely that we will have, that it will be instead the Fed coming down to the market. Another way of looking at this is that, yes, the Fed is indeed looking at inflation in round numbers at around 5%, and their target is 2%. But the issue is that if you look at your Bloomberg screen and check out what ISM services paid prices have done, they have basically moved down, and they are very important leading indicators of core inflation, headline inflation, super core, also a very important leading indicator of even average hourly earnings. So we will get inflation coming down. That's also what the consensus expects. But the Fed has to stay hawkish because they need to talk to inflation expectations and make sure that they remain well anchored. And then once actual inflation starts to come down, then they begin to change their tone.
Torsten, I think a lot of people have struggled with how the conversation has shifted on programs like this so far year to date. In just 3 months, 3 narratives. we went, as you say, and we've talked about this, we went from saying soft landing to no landing to hard landing. Torsten, why won't we be somewhere else in a month from now? Who's to say we won't be talking about something totally different?
True. I have people asking me, well, why are we not going to be in a crash landing? So I still think that's really unlikely because the Fed is totally aware of all the risks that we have in front of us. But it's totally absolutely right what you're saying, that we have shifted the narrative around. That's why the MOVE index has been so elevated, that there's been all this uncertainty and continues to be elevated, all this uncertainty about what will happen to inflation, what will happen to rates, whereas VIX and equities have just remained relatively calm throughout most of this period. So it is true that this pendulum swinging back and forth about is it a soft landing, no landing, hard landing, might even be a crash landing. All that is a very important reason why markets are so volatile and why implied vol, both in rates and equities, continues to move around so much.
Jobless claims a little bit earlier this morning, upside surprise. That was about 37 minutes ago. That came in at 228. The estimate was 200K, and a big upward revision to the previous number as well. Payrolls come out tomorrow morning. Katie Lyons, payrolls have come in just a little bit. We were looking for 240, we're now looking for 235.
Yeah, that's right, which arguably relative to history is still fairly robust job growth, but that would be a slowing in the pace of non-farm payrolls additions from the month of February. So it's really going to be about whether or not tomorrow's print confirms what the data we've gotten over the last 24, 48 hours suggests, which is weakness, the lagged effect of monetary policy tightening starting to show up in the economy. Maybe you see that in this initial jobless claims print, which, as you suggested this morning, John, is the wrong kind of upside surprise, both in the weekly print and the prior revision, which, as you suggested, did move significantly upward, though part of that is due to updated seasonal factors. Then for tomorrow's jobs report, 235,000 is what we're looking for on payrolls. But the other factor that is going to be incredibly important to the Federal Reserve is average hourly earnings. We are actually expecting a tick up in the month-on-month growth to 0.3%, though year-on-year basis, we are expecting a cool down from the pace of February to just 4.3%. So the question really is, does this confirm what the market believes, which is that this Federal Reserve is going to have to start turning around and cutting by the end of this year? You see that evident in the two-year yield once again today. Fifth day in a row, this yield has come down. That is the longest stretch since July of 2022. And at 3.77%, we are, more than 1% below Fed funds. So this monetary policy sensitive part of the curve suggesting that the Fed is wrong, this market betting it is right, and perhaps the data we're getting just fortifying that belief on the market's part, John.
Kelly, thanks for that. Kelly Lyons down in Washington. We'll continue that conversation with Kelly through the next 24 hours on TV and radio, including tomorrow morning. Don't miss this. Just a programming note for you all. We will be with you tomorrow morning. Our coverage will start at 7 a.m. Eastern time. It will go through until about 10 a.m. Eastern time. We'll be catching up with Priya Misra, Ellen Zettner, Randy Krosner, and Mohammed Al-Erin in the studio here in New York with us around the table. Looking forward to that, to break down that jobs number at 8:30 Eastern time. The estimate, as I say at the moment, 235,000. The previous number, 311. Troy, do you anticipate that some of the weakness we've experienced this week will show up in that number tomorrow morning?
Yeah, you're going to continue to see that downward trend that you articulated. Remember, we still have historically a very tight labor market. The problem is the trend, right? And we see whether it's industrial production or services or CapEx, business fixed investment, housing, all of those data points continue to deteriorate, and labor lags dramatically. And so you're just starting to see this show up. And, you know, our key point has always been, look, if you look at this environment, the only thing keeping the global economy afloat has been the U.S. consumer. And a lot of the excess savings has been run down. So as soon as you see the labor market start to crack, you know, you can forecast recession coming in 3 to 6 months. And clearly the mini banking crisis that the Fed and the FDIC and the Treasury, to their credit, have done a very good job ring fencing so far, creates an additional risk factor because of credit contraction at the real economy, as opposed to money supply contraction, which principally impacts financial assets.
Troy, if the only indicator you had was the S&P 500 over the last several months, perhaps you wouldn't even notice that some of these things were happening. We've just been in this range of 3,800 to 4,200 on the S&P.
Yep.
Troy, based on what you've told us in the last 10 minutes or so, if we were to break that range, you expecting that break to the downside or to the upside?
Oh, yeah, for sure. I mean, we've had a very strong bear market rally, you know, driven principally by lower interest rates and a kind of somewhat bizarre expectation that a aggressive Fed pivot was good for the economy and for earnings. Now we think 32 to 3,400 is a rational bear market low. We think multiples more than likely did bottom out. Multiples always bottom out prior to earnings bottom out. But if you look forward and just put a 16 to 17 multiple on 200 trough earnings, that gets you right to that 32 to 3,400 range, which basically is a 29 to 34% peak to trough bear market. Not nearly as severe as 2008, not nearly as severe as 2002, but meaningfully worse than 2018 and the various shocks we had in the post-GFC period.
Is it fair to say you're not a fan of the tech trade that's performed so well year to date?
Not at all. I mean, look, the 17 to 21 playbook for investors was be long duration assets, be long growth. Those companies obviously did a tremendous job compounding free cash flow and earnings. The problem now is so much of that upside recently was driven off exceptional lows that were created last year when the NASDAQ was down over 30%. And the idea was, hey, here we go. Rates are low again. It's time to roll out the go growth playbook or the growth playbook. And the folks forget that the number one determinant of any equity outcome is beta. And so if the S&P is going to drop 15 to 23% from here, it's very unlikely that the NASDAQ drops by less than 15 to 20, and in fact will more than likely drop in line with the S&P or perhaps even worse.
Well, the NASDAQ year to date at the moment up about 15%. Troy's going to stick with us. Torsten Slock as well. We'll continue to break down the economy and include a bit of China into this conversation as well. Let's get you some movers. We can do that with Abby. Morning, Abby.
Morning, John. Well, let's start out with the shares of Costco, which are falling sharply at session lows, pre-market session lows, I should say, down about 3%. This, of course, after same-store sales for the month of March came in up just 0.9%, excluding gasoline, another down month, the lowest amount of growth since April 2020, really putting into question what's going on with the consumer, the strength of the consumer. Alibaba had been up more than 1% on a report of a chat GPT-like tool launch plan that it's planning, but it seems that the mood of the morning is really weighing on those shares of Alibaba. And then finally, Alphabet up 0.6%, also off of its highs, as Google CEO Sundar Pichai has said that their search, the Google search, is to feature an AI-like feature, John.
Abby, thank you. Coming up on this program, Trump making a move on DeSantis donors.
As soon as he starts saying he's going to get indicted and he commands the headlines on a near daily basis, you see DeSantis slipping. It gives Trump a nearly daily platform for fundraising and for grabbing all the attention, which has been the key oxygen that supported his political career for years.
That conversation up next.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
The challenge for every other Republican that they're facing is that Donald Trump continues to suck up all the oxygen in the room. And it's absolutely impossible to get traction against this guy. And we've seen this over the last couple of months. When he made his announcement in November, he was basically ignored, which created an opening for Ron DeSantis to start climbing in the polls. But as soon as he starts saying he's going to get indicted and he commands the headlines on a near daily basis, you see DeSantis slipping.
Last week, Donald Trump was the first former president to be indicted. Now, he's using the attention to make a play for the competition's backers. Donors supporting Florida Governor Ron DeSantis are getting the pitch from the Trump campaign to jump ship. A 3-page memo seen by Bloomberg looks to highlight Trump's rising poll numbers and DeSantis trailing behind. Politico reporting the campaign has already raised something to the tune of $12 million since the indictment. AMH joins us now from Washington. Anne-Marie, I think it was the New York Times that said the former president has a new running mate, and it's this court case.
Yeah, that's right. Potentially District Attorney Alvin Bragg. He's using this in this memo, Jonathan, this arraignment, these 34 felony charges as a way to try to bring in these campaign dollars. We've seen it work when it comes to these emails being sent out to everyone who subscribes to the Trump campaign. And as you said, this is millions of dollars in the double digits since we got the news of this indictment. But now it looks like in this 3-page memo seen by a colleague here at Bloomberg that what the campaign is trying to do is go after some big money donors. Remember, a lot of these individuals, like the Koch brothers, Charles Koch, the network he started with his late brother David, Schwartzman, all of these individuals, Ken Griffin, Jeff Yass, these people have already signaled that they want to move on from Trump world, and they are squarely going to be backing Governor DeSantis. And a few weeks ago, we saw Governor DeSantis bring a lot of them in at a retreat in Palm Beach at the Four Seasons. So this really says to me that former President Donald Trump clearly views Governor DeSantis as his #1 running mate to try to get the 2024 bid from the Republicans.
As we've talked about this, Anne-Marie, this has taken all the oxygen out of the room down in Washington, D.C. We're not talking about some really important issues, including the relationship between this country and China. You caught up with Speaker McCarthy just yesterday. This is what he had to say.
What China needs to understand is they can't dictate who a Speaker of the House can meet with, maybe with foe or friend. For the same moment that Macron's sitting down with President Xi, I think that's great. I would sit down with President Xi.
Anne-Marie, fantastic work just yesterday. What was the big takeaway for you?
Well, I don't think he's going to Beijing anytime soon. And also, he's not going to Taipei anytime soon. One thing that really struck out to me, Jonathan, is that this was a muted meeting. Remember when Speaker Pelosi went last summer? Kevin McCarthy said if he was going to Speaker, he'd want to go. But to really take the tone down, given the consequences that trip was last summer, it was done in Southern California. We saw some consequences coming up from Beijing, but not on the same level.
AMH, awesome to catch up. Anne-Marie down in Washington, D.C. Torsten Slok, I wanted to come to you on China. Not the politics, let's park that. Let's talk about the economy. You're sitting there now talking about a credit crunch. You see evidence for it in America right now. You've got a call potentially for a hard landing. What happened to Chinese growth bailing out the global economy, Torsten? Where's that now?
Yeah, so at least the outlook for now is still relatively stable for the rest of the world, including China. So, but obviously, if the U.S. does have a hard landing, then China and all exporting countries will be harder hit because they simply depend still on the U.S. consumer to a very significant degree.
Can the U.S. economy decouple in the way that some people think, Torsten?
Well, it depends a lot on the nature of the shock. I mean, obviously, when the shock a few years ago was a pandemic, obviously everyone was hit. And before that, in 2008, of course, the shock was also quite global. Now the shock really is originating in an inflation problem that has been particularly pronounced in the U.S. And now adding onto that a shock from the regional banks in the U.S., it does make it a very U.S.-specific issue that we are facing. But as usual, when the U.S. has a cold, the rest of the world does sneeze. In other words, we will have quite some significant consequences for the rest of the world, including Europe, if we do have a harder landing in the U.S.
Well, Troy, you've heard what people think about this when it comes to the market. Transatlantic rate differentials, they're expecting them to develop in a different way this time. The Fed will have to pause. The ECB can keep on going. Off the back of that comes the FX call for a weaker dollar. Troy, do you think some of that maybe is a little bit misleading?
Yeah, and you know, when we look at this in our tactical asset allocation franchise or multi-strategy fund, we just keep coming back to, look, you've had some degree of outperformance in Europe so far this year. However, you know, when the U.S. has a recession, what will typically happen then is the dollar will strengthen substantially. You know, obviously the channels of trade will break down quite significantly, and that will revert us back to at least shorter term U.S. outperformance in a more significant sell-off. So, you know, I think in general, again, in this environment, you want to protect capital. You want to focus on free cash flow and cash flows that are resilient. You don't want to be a hero. You want to focus on that Northwest Quadrant, the efficient frontier, and find relative value opportunities like selling extremely expensive European interest rate vol and being long very expensive U.S. rate vol or yield curve steepeners that aren't speculating on dramatic direction, but have very good asymmetry to the most likely market path forward.
Torsten, I've got about 20 seconds, so let's make this a yes or no. Was the March rate hike from this Fed the last hike?
Yes.
Torsten Slog, Troy Gayeski, to the two of you, thank you. There's a call. I think a lot of people share that view based on market pricing. Looking at futures right now, we're down about 1/3 on the S&P 500. Coming up, the morning calls, and later, the case for energy. Why Cameron Dawson of New Edge Wealth is sticking to her overweight call. That conversation around the opening bell. Your opening bell, 7 minutes away.
Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
5 minutes away from the opening bell, pulling back just a touch, not too much. We're down about 1/3% on the S&P 500. 2-day slide coming into today. On the NASDAQ, a 3-day slide coming into Thursday. Equity futures on the NASDAQ 100 down about 0.6%. That's the price action. Here's some morning calls for you. First up, JP Morgan downgrading Mosaic to neutral, $46 price target. Forecasting a challenging year as lower commodity prices weigh on upcoming results. That stock is down a little more than 3%. Your second call from Raymond James upgrading Wells Fargo to a strong buy, expecting the company to benefit from the SVB fallout. That stock is positive by about 0.8%. And your third and final call from the team at Oppenheimer, cutting its Amazon price target down to 125, saying more layoffs are necessary for e-commerce to become meaningfully profitable. That's stock down about 0.7%. We'll talk about Amazon and Google trying to make some of those layoffs over in Europe a little bit later this morning. Coming up next, the Nasdaq facing a fourth day of declines. New Edge Wealth's Cameron Dawson says the pain trade in big tech is still higher. That conversation just around the corner. Your opening bell up next.
Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Two-day slide on the S&P. Will it become 3? About 20 seconds away from the opening bow. Futures lower by 0.2% on the S&P 500. 3-day slide already on the Nasdaq. Down again on the Nasdaq 100. Will that become 4? We're down about 0.5% on the Nasdaq. Equities softer through the week off the back of weaker than expected economic data. Let's the opening bow. Switch up the board and get to the bond market. Yield shaping up as follows. Lower again on a 10-year. A break of 330. 329.39. On a 10-year yield, we're down a single basis point, maybe even round it down to down 2 basis points on a session so far. With the bond market at the front end, we give up some of the move from earlier this morning. The 2-year now basically unchanged at 378. Yesterday had a little look at the 360s. Euro dollar having a little look at 108 right now. A break of 109. We're down about 1/10%. Weaker euro 108.93. And crude, let's call it unchanged. We're down about 1/10% there. $80. We hold on to 80 on WTI. $80 and about 50 cents. About 30 seconds into the session, your equity market taking shape. We are lower by 0.2% on the S&P. On the Nasdaq, we're down about 0.4%. One stock to watch at the open is Costco. Shares falling after posting its lowest US sales growth in nearly 3 years. Abby has more. Hey, Abby.
Well, John, this is the worst fall for this stock of the year, and it has to do with that weak comp sales growth. Folks disappointed. Now, if we take a look at the quarterly version, same-store sales, we are going to see the direction of what's going on here. Back during the pandemic, when you had folks stockpiling and also looking for this big box retailers discounting, same-store sales of 17%. The last quarter just closer to 6%. For the month of March, up just 0.9%, excluding the effect of gasoline. So this is really, these numbers moving in the wrong direction. It's the smallest gain since April of 2020. And the bigger point here, John, of course, is the strength of the consumer. If consumers are not flocking to a big box discounter for those discounts, where are they going? Are they just really slowing down their shopping overall? You know, it's interesting, though, because this stock has outperformed on the year the overall staple space, but we can see with today's decline, it's coming back in line. And one big question here would be, up 15% at one point earlier this year, are we going to see it even out and really perform just in line with that staple space, which is about flat on the year?
Down more than 3% right now. Abby, thanks for that. Different story for FedEx, as you know. Shares touching a 7-month high, with a number of analysts raising their price targets on the courier's new cost-cutting strategy. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. We're up 0.6% on FedEx 24 hours after the restructuring, where FedEx will merge its ground and express units. The highest level since August on the stock. It was a somewhat muted reaction, all told, by the end of Wednesday's session, up a percentage point or so off a session high of 4%. But we do see a number of analysts raising price targets. They're basically calling out that simplicity is key. They feel that this integration of the two units and simplification of the business structure will take time. But if you think about what Morgan Stanley is saying, for example, through Ravi Shankar, it puts the company on a path to what he calls the holy grail of integration gains. It's a more simple entity, according to Jefferies. At the end of the day, I guess, John, that when one way of looking at cost cutting is to tighten the belt, the other is just to go back to basics with your business. And the street's certainly cheering up. We're now up 0.8%.
Some cost cutting is easier than other cost cutting. Ed, we're going to talk about some of the difficulties Amazon and Google are having a little bit later in the program. Ed, stay close. I want to build on this story from FedEx. Plenty of upgrades. Raymond James had this to say: upgrading shares to outperform and writing, quote, integrating its primary express and ground offering, focusing on attacking costs and enhanced capital allocation scrutiny all set the stage to drive improved shareholder returns. Were management to be even remotely successful, then we'd see material earnings and free cash flow upside in the coming years. That stock's up again by 0.9%. Let's get back to the earnings. Shares of Constellation Brands topping profit estimates and boosting its quarterly dividend by 11%. Isabel Lee has more. Hey, Isabel.
Hi, John. It was a mixed bag for Constellation Brands, the producers of beer, wine, and spirits, the likes of Corona and Modelo. Shares of the company fell after the company reported revenue falling short of estimates. The company posted a net profit of $223 million, which is down around 44% last year. Sales also fell to 5% to $2 billion, which is slightly below forecast. But adjusted EPS came to $1.98, which is beating estimates. Here's a breakdown. Beer sales fell 2% after beer price hikes last year slowed consumer demand. Wine and spirit sales also falling 9%. Those categories also saw a big expansion in operating margins. Some silver lining, the company is now expecting adjusted EPS that's higher than estimate and raised its dividend to 89 cents from 80 cents per share. The stock overall has fallen around 5% in the past 12 months, so we'll see.
Isabel, thanks for that. The latest on Constellation Brands. Looking ahead to next week, it's going to be about the earnings from the big banks. The dates as follows. On the 13th, First Republic, which is a name a lot of you have been following over the last few weeks. JP Morgan on the 14th, so that's Thursday and Friday. Perhaps Western Alliance in the last couple of days has shown us how not to do it. They provided us with a little bit more clarity around their deposit base just yesterday. That stock is now up by 2%. Kaylee has more out of DC. Morning, Kaylee.
Well, good morning, John. It took them a hot second to actually provide that clarity on deposits, because first on Tuesday, they put out a statement updating their financial status, no deposit info included, and then midday yesterday finally put out that information, which helped the stock come off of the 19% drop it had at one point yesterday. We are seeing a bit of a recovery this morning with the stock up roughly 2% at the open here. But that deposit figure came in less bad maybe than anticipated. Yes, deposits were down 11% from the end of the fourth quarter to the end end of the first quarter of this year came in at $47.6 billion at the end of March. But perhaps some good news coming in the fact that a larger share of those are insured, about 68%. And the bank says that the situation has stabilized as of March 20th, and they actually had $1.2 billion in deposit inflows in the first 4 days of this month. So the question really is now, is the worst over, not just for Western Alliance, but regional banks largely who have been struggling with deposit outflows as there remains a lack of clarity around policy, around insurance, and of course we have signs stacking up of a weakening economy. So all of that is in focus for these stocks that have been brutally punished this year. Western Alliance has lost half of its value year to date. First Republic down 89%. Regionals as a whole down nearly 30% over the span of just a couple of months, John. So the question is going to be now, as we look at these earnings reports, what they say about those deposits and, frankly, just their health overall, John.
Looking forward to those earnings coming out next week. Kelly, great coverage as always. Kelly Lyons there down in D.C. I keep returning to the calendar. What a week we've got lined up. Tomorrow morning, payrolls. On to next Wednesday on the 12th, CPI. The 13th, First Republic. The 14th, JP Morgan. And a ton of bank earnings in between. This is where we stand right now. Equities down about 0.4 on the S&P. More weakness in the NASDAQ again. The composite there down about 0.75% on the NASDAQ. Even with, this is your backdrop in the bond market, yields lower again on a 2-year by 2 basis points to 3.76. Cameron Dawson and New Edge Wealth looking ahead to earnings and writing the following. Yields dropping in the face of weak PMIs suggest that there is more earnings risk on the horizon, but that has not been reflected in estimates just yet. Cameron, I'm pleased to say, joins us now. Now, Cameron, you've put it in the way that I've been asking. Is bad news just bad news?
Well, if you base it on the last 3 days, it certainly seems that way. It means that equities are starting to wake up to the fact that usually when you see pricing for a lot of Fed rate cuts and lower yields and a re-steepening of the yield curve after an inversion, it means that there actually is economic and earnings risk on the horizon. And what we've seen within markets is really just thinking on that easier policy will help valuations. But if you look at the earnings front, you're still pricing in flat earnings growth on a year-over-year basis in 2023, and then a 9% jump in 2024. If we have a recession at any of those points, those numbers are still too high, meaning that you have to revise them lower and that the valuations look even more stretched where we sit today.
Cameron, can you take any comfort from how the bond market's responded to the incoming data this week?
No, because the bond market is responding with continuously lower yields, and we're about to break some pretty important support for yields, which would suggest that the pricing in of those Fed rate cuts in the back half of this year, that the bond market is getting even more confident that those will actually materialize. But we are questioning if the Fed will deliver on those rate cuts. They continue to say that they see no urgency in order to cut rates. They're afraid of inflation coming back. So we have this widening chasm between what the bond market is thinking the Fed will do and what the Fed is saying it will do. So it certainly points to continued volatility, not just for equities, but also for bonds.
Now, equities right now on the screen, the NASDAQ's down about 0.8%. Cameron, this is even with another rally in the bond market with yields just a little bit lower this morning by a couple of basis points or so. Can you draw some conclusions about where you think this relationship between bonds and equities is going?
Well, within tech stocks and within growth stocks, we do think that they move too far too fast in getting to a huge valuation premium to the broader market. The fact that they traded to a nearly 40% premium for the tech sector just back last week would suggest that they were already pricing in a big, huge rate cut path and a much easier Fed already into the price where they were today. And they were ignoring the fact that just because they're tech or just because they're growth doesn't mean that they have complete earnings resilience. That if we do actually have a weaker economy, do actually have an earnings recession, they will experience weaker earnings, which just then again puts their valuations to be even more extended as you see those earnings revised lower.
So Cameron, let's say the bond market's right, the disinflationary bust arrives. Given what you've just said, where would you expect equity market leadership to come from in that world?
Well, it likely would shift again further away from the cyclicals into the defensives. And that has been something we've been seeing over the past couple of weeks. Cyclicals have really started to break down after they led the market higher from the October low, as we started seeing that no landing data, much better growth data to begin the year, and you did see cyclicals leading. But over the past couple of days, you've had some pretty big downside volatility in things like industrials and materials and even the semiconductors, would suggest that there is more growth risk on the horizon, and would suggest that as you look into more earnings uncertainty, that you want to lean more into defensives, so your classic defensives like healthcare, utilities, and staples, which have really lagged to start this year.
Cameron, a couple of years ago when someone said defensive, it wasn't just healthcare, utilities, and staples, it was also tech. You touched on it briefly there. Do you think people still underestimate just how cyclical some of these names might be?
I think that we have to think of tech in very specific camps, because there are parts of tech that are highly, highly cyclical. So if we think about semiconductors, of course, very sensitive to global manufacturing cycles, hardware very sensitive to IT budgets on a corporate basis, but software tending to be less cyclical. They have more recurring revenue bases, and so that does help them have much smoother earnings through the downside in the economic cycle. So there's probably portions of tech which will be much more defensive than other parts of tech, but if we look broadly, the index does actually have much better earnings performance in down cycles than you see in other cyclical industries. So back in 2020, as well as during the great financial crisis, tech did outperform on an earnings basis if you compared it to things like industrials or materials. But if we look deep underneath, it really was because of those more defensive parts of the tech sector.
Cameron, great work as always. Cameron Dawson there, who joined us a number of weeks ago and said, beware the bull steepener. The economic data is starting to validate that move in the bond market, and now starting to see some weakness develop in the equity market as well. Third day of losses on the cards on the S&P 500. Day 4 on the cards on the Nasdaq. On the S&P, we're down 0.5%. On the Nasdaq, we're down 0.75%. Yields just a little bit lower at the front end by 2 basis points on a 2-year 376. Your 10-year just sub 330 at about 328. Coming up, let's talk tech. Tech workers left in limbo amid cost cuts.
There's probably more to come, whether it's in terms of business failures, bankruptcies, layoffs.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
One of the things we've learned in the course of our episodes about trucking is that there's like 2 distinct trucking markets, and there are the port drivers, and then there are the long haul over the road drivers. And you were talking about this sort of like culture of independence, and people get into trucking, you know, there might be a reason that they're not sitting behind a desk in some email job. But is that true for the, like, is the culture of port trucking the same as the over-the-road, like, convoy style? They made movies about it. Like, is that the same? Because my understanding, or at least my impression, was that the port drivers were more immigrants and people who had fewer opportunities in the first place. And also, and sort of related to that, and you know, you mentioned that there have been these protests in California against AB5. Are the people who are coming out to protest them, do we have reason to think that they're like representative of the broader trucking industry, or is it just like a certain group subset within that space who is particularly threatened by this?
You know, it's funny. I have reached out to truck drivers kind of like in my network to ask what they think about AB5. Most of them are long haul drivers. Many of them are based in the Midwest or, you know, the Southeast. And when I asked them like, oh, what do you think of this law? They were like, I don't care. It's in California. I don't live in California.
Moment news breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
There's probably more to come, whether it's in terms of business failures, bankruptcies, layoffs, which we're already seeing well up the wage and managerial spectrum, which is another thing that's different about this contraction, slowdown, whatever you call it, eventual recession, is the layoffs are happening more top down versus the typical start with bottom-up layoffs.
Big tech layoffs are stalling in Europe. The same companies announcing job cuts here in the United States, struggling to let go of workers across the other side of the Atlantic. A Google spokesperson telling Bloomberg the following: "We've been working carefully through each country where reductions are taking place to fully adhere to local legal requirements, which are complex and take time." I said Ed should stay close. Ed's back with us now on the West Coast. Ed, are you telling me they're finding it difficult to let people go over in Europe?
Yeah, very difficult. The reality is that labour protections, particularly within the European Union, make it hard to enact layoffs where there has not been prior consultation with workforce bodies, and that's where the detail in the reporting is. According to one Bloomberg source, particularly in France and in Germany, Alphabet, the parent of Google, and Amazon are having to negotiate with work councils. These are company-specific peer-elected groups that negotiate with management on what the size and scope and specific roles impacted by layoffs look like. Then you go to the specific jurisdictions and the specific companies. In Alphabet's case, parent company of Google, they are trying to find workarounds. So in France, according to one source, they're leaning very heavily into voluntary departures and looking at attractive severance packages that hopefully will entice workforce in that nation to leave, right, of their own volition because of the issues that are ongoing. That said, sources telling us that the resolution in that market in France for Alphabet is weeks away. And you have to remember that these are layoffs and cuts that were announced going back towards the end of last year. Another example, Amazon in France, for example, has offered senior managers a whole year's pay, 1 year's worth of pay, Jonathan, if they resign. Then you go to the complications of the technology sector. How are they going to deal with the issue of stock grants and other compensation? Well, they're basically granting long-term leave to those employees that they're pushing to depart in order to allow them for their stock to vest and their bonuses to be paid out. So you can see the complication that's going on here. And as you point out, Google issued us that statement also acknowledging that in some markets, Romania, Greece, Austria, they're not going to try and do layoffs. Amazon declined to comment on the story.
Ed, can you give us some more clarity? Is this going to change their thoughts, the decision they made about cutting people off, or will it just make it more expensive to do so?
The cost of it, is quantified, in both Alphabet and Amazon's case, right? They put dollar figures on it in the sort of low billions of dollars. One thing that sources were telling me in Alphabet, the parent company of Google's case, is that there were layoffs that were made or announced, and very quickly managers realized that there were people on those lists that they really still needed. That's an example that we heard about in Twitter, for example, which is a very different ball game, but where there were people that were cut that were then asked to come back. I think the breadth of these layoffs has made it very complicated for big tech companies because they're finding that using a scalpel takes too long. So they come with a sledgehammer. This is also something we've reported in Meta's case, but may realize that actually roles they're eliminating are quite useful for the future. So they're having to do a rethink.
Interesting.
Time is the real issue.
This is fascinating. I'm looking forward to the program with Caroline Hyde in about 2 hours from now. I'm sure you'll pick up on this story. We've talked for years about the labour market flexibility here in the United States and the absence thereof over in Europe, and this is a perfect case study example of that taking place. Speaking of Europe, Credit Suisse, top executives facing bonus cuts. The Swiss government ordering their payouts to be cut by up to half or outright cancelled following the UBS takeover. Bloomberg's Jan-Patrick Barnett joins us now for more. Jan-Patrick, I have to say, when I saw this, I wasn't really surprised. Were you surprised?
No, not at all. I mean, bonuses were already frozen last month, and I mean, it makes total sense from a political perspective, especially if you are a politician who wants to be re-elected. You simply can't pay out bonuses in the millions, and on the other hand, you grant billions of euros for protecting this merger, for loss absorbing, which I'm pretty sure UBS will make use of. It's simply not a political message that you want to have out there. Of course, it creates a whole lot of problems for the new company, UBS, Credit Suisse combined internally, because also not every manager is responsible for what happened to Credit Suisse. And if you've done a decent job in your area of responsibility, and you're now being one of those whose bonus is being cut or even outright suspended, it's probably not being good for morale. And maybe you want to look somewhere else, and that will make it harder for the new company to keep the high-performing talent on board.
Jan-Patrick, you and I talked earlier this week about what Colm Kelleher had to say, the UBS chairman, about how long this integration could take, maybe up to 4 years. When do you expect to see the headlines, the real news about the degree of job cuts we might get from that combined entity?
Well, I would expect that we see something in the next 2 weeks. I guess they will need to figure out some details here. And you just spoke about like labor rules in Europe, and they are also very strict in Switzerland. So there's a lot to figure out there. But we have the UBS earnings coming up at the end of the month, and I'm pretty sure that they want to present at least some roadmap, what they want to do for the next couple of weeks and months. And so I would expect that we see more of details and more of planning coming to light in the next couple of weeks.
April 25th is when we get that earnings release. Jan-Patrick, thank you, sir. As always, just the latest developments in the job market, both in tech and in finance, both in Europe and in the United States. Let's get you some sector price action. Equity's a bit softer this morning. Here's Abby.
It certainly is, John. We're looking at a third down day for the S&P 500, as you have mentioned, the longest losing streak in about a month. And it's a risk-off sector tone. It's very interesting because the only sectors higher today, they're basically those defensive sectors, utilities, healthcare, real estate. Real estate's not officially defensive, but it has dividends. So folks are looking for those dividends, that safety, especially as yields fall. Tech and consumer discretionary, mega cap tech down about 1%. Let's take a look at that sector over the last 4 days, along with the banks, actually, and this is the last year. But over the last 4 days, both of these sectors lower. You can see over the last year, we certainly have tech outperforming, a lot of this having to do with the recent snafu, of course, with regional banking.
It's tech outperforming in a monster way here today. Abby, thanks for that. The NASDAQ doing tremendously well. Year today on the session, not so much. We're down about 0.7% on the NASDAQ. Call it 0.8% lower on the NASDAQ 100. We're down 0.4% on the S&P. Busy morning tomorrow morning. Payroll's just around the corner. Busy week next week as well. Your trading diary up next.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The yield on the 2-year lower for 5 straight sessions, capturing some of that weakness in the data and the equity market responding with bad news meaning bad news. We're down about 0.5% on the S&P. Jobless claims, the wrong kind of upside surprise a little bit early this morning. The Nasdaq down 0.8%, even with that move developing in the bond market. That's the price action. Here's your trading diary coming up. St. Louis Fed President Jim Bullard speaks at the top of the hour tomorrow. The main event is Payrolls Friday. We'll look out for that. More Fed speak coming next week with Williams, Kashkara, Harkey, and Harker and Goolsby all coming up. FOMC minutes and US CPI coming up on Wednesday. PPI and another round of jobless claims on Thursday. Look out for our special coverage tomorrow morning. It starts at about 7 a.m. Eastern Time. We'll be catching up with Priya Misra, Ellen Zentner, Mohammed Al-Arian, and Randy Krosner. Looking forward to that. For the rest of you, enjoy the long weekend. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners. and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford